Good morning, everyone, and welcome to today's class on the net investment income tax, other taxes and penalties, and quite frankly, everything except the kitchen sink. I call this my kitchen sink course because it's the course where I cover everything that's left over and hasn't been covered somewhere else. Important things that we need to cover that we haven't managed to cover somewhere else in all of the various courses that I teach. And to just give you an idea of the scope of today's class, we're going to be covering the tax on uncollected Social Security and Medicare wages, household employment taxes, the additional Medicare tax, the net investment income tax, various other taxes. We'll be taking a look at federal refunds, including how to receive a refund, refund offsets, and injured spouse allocation. We'll also look at the amount you owe and the payment options you have when you decide you need to pay but you can't afford to pay, or if you can't afford to pay, just how are you going to go about doing that, and also what happens if you need innocent spouse relief because the Iras is after you for money you think that is owed by your spouse. We'll look at estimated taxes as well as the penalty for underpayment of estimated tax. We'll look at power of attorney and tax information authorization. We'll learn how to do an amended return. And finally, we'll polish it all off or finish up the day with a look at the Kiddie tax on investment income of children. So lots to cover. Let's move over to what is actually page 3 of the manual. And those of you who just tuned in, if you printed the manual before I put that table of contents in, you're going to be like one page off from me all day. But other than that, the content should be the same in both our manuals. So here we are on page 3 of the manual looking at other taxes. And I just wanted to kind of zero in on the back page of the 1040 and study it a little bit with you. Because for most of income tax law, when we're preparing tax returns for our clients, we really just focus on line 44, figuring the tax and entering it on that line. And then from that point forward, we move on to credits. But unfortunately, it's not that simple for every taxpayer. Many taxpayers have to pay additional kinds of taxes, and one of the additional kinds of taxes people have to pay is the alternative minimum tax. And beginning in 2014, there are also individuals who may have to pay that excess advance premium tax credit back, and that is a new line, a new tax created on line 46. But you're still not done there, because as we move down the form, you will see we also have the line for self-employment tax, unreported Social Security and Medicare tax from either Form 4137 or 8919. And 4137 is the tax on tip income. 8919 is tax on wages that were not reported on a W-2. And we are going to talk about 8919 quite a bit today. There's also the additional tax on IRA and other qualified retirement plans. We covered that in our course called Pension and Social Security Income. And there is also the household employment tax from Schedule H, and we're going to learn about that tax today and how to complete Schedule H today. There's also the tax for the first-time homebuyer credit repayment. We'll briefly touch on that, not too much. And then there's the healthcare individual responsibility payment. That is an additional tax that has started beginning tax year 2014 for people who do not have health insurance and are required to have health insurance. We covered this tax really in its entirety in our course called Understand Our Tax Aspects of the Affordable Care Act. Fumbling a little here, but Tax Aspects of the Affordable Care Act is the course in which we discuss that particular tax, and so I'll not be covering it today, but it is a line on the form, of course. And then finally, we ran out of space. There are so many other additional taxes that Iras had to create a couple more check boxes and then enter some codes. So we are looking at taxes from Form 8959, which is the additional Medicare tax. There is Form 8960, which is the net investment income tax, and we will be covering both of those today. And then finally, if you couldn't fit the tax anywhere else on the form, but it still exists, you would need to enter a code to describe the tax that you are entering on line 62. And we'll look at a list of the various types of additional taxes that a filer may have to pay. And then finally, when we're still not done with all of the above, the IRS can impose upon you an estimated tax penalty, and that's entered on line 79. So we're going to be looking at most of these taxes today in varying levels of in-depthness. And let's move on to the next page. And we're going to actually start on line 44 because really to have a discussion about tax, I think we need to really understand how tax is computed in the first place. And we've looked at income tax calculations in some of the very earliest sessions of my courses. And we've also looked at tax calculations when you are figuring capital gains. But today I thought I'd take it to the next level, and we would look at tax calculations when you have capital gains plus the foreign earned income exclusion, because that's about as complex a tax calculation as I could come up with. But let's just take a look beginning with line 44, which is where you enter your tax, this line right here. Normally when you figure your tax, you figure your taxable income on line 43, and then you go to the tax tables and find your filing status. You find the income level you're at, and that's your tax. But it's not always that simple. So let's take a look first at these tax tables. And these tax tables are kind of wonderful. I like tax tables. Tax clients like to sit across the desk from me and say, what tax bracket am I in? What tax bracket am I in? I feel like I'm in the 80% tax bracket. And of course, there is no 80% tax bracket. There's nothing remotely close to 80%, although once you add up all of the various taxes that an individual might pay, it may seem like they're getting close to 80%. There is no 80% tax bracket. So firstly, we have for line 44, the IRS offers a series of schedules, rather. We have Schedule X, Schedule Y, Schedule Y2, and Schedule Z. Which schedule you use depends on your filing status. If you are single, you would use Schedule X. And Schedule X shows that if your taxable income is between $0 and $9,075, you are in the 10% bracket. And when your income exceeds $9,075 but is up until $36,900, you are in the 15% bracket. And then after that, of course, comes 25, 28, 33, 35, and finally, the top bracket of them all, the 39.6% bracket. This 39.6% bracket was first introduced early on in the Clinton administration. It was a tax that was created to help reduce the deficit. It did so quite nicely until the Clinton era ended and Bush came in, and then taxes were just cut across the board, and of course we immediately went into deficits. And so this tax actually has been reintroduced since Obama came back into office. We have it back again. I think our deficit situation is improving, but not something I follow that closely. At any rate, this is a tax that is imposed only on higher income earners, and if you are single and your taxable income exceeds $406,750, you move into this particular bracket. We have more tables for the other filing statuses. Now, most people are going to go to the tax rate worksheets and look up their tax using the worksheets. But if your income, that is your taxable income, is over $100,000, you run out of space on the tax tables. And so you move over and compute tax instead by hand on these worksheets. And if you have computer software, your computer software is doing it for you. And Section A figures the tax for a single person with income of $100,000. When we say income, we mean taxable income of $100,000. And then we have a table for the married filing joint status, a table for the married filing separately status, and then finally a worksheet for the head of household filing status. So let's look at how things get a little bit more complicated yet. You're working with an individual who has to figure their tax, and they're figuring the tax because they have foreign earned income exclusion as well as some capital gain income, and see how that works. And we're going to start with this header right here, which says other tax computations may be required for line 44 because the tax shown on the tax tables or the tax computation worksheet may be reduced or increased in certain situations, such as you have income from qualified dividends or capital gains. If you do, then the worksheet's actually going to show you too high a level of tax. The investment income of $2,000 for certain children, these children file their own returns, and they're not going to be able to use the tax tables directly to figure the tax on their income. Instead, they're going to have to fill out 8615 and figure how much tax they have to pay at their parent's higher rate. And then comparable but different is when a parent decides to include their child's income on their return, and then again they have to do a different computation. And finally, another computation is also required when you are figuring the foreign earned income exclusion. The tax tables alone do not work for you when you are figuring the foreign earned income exclusion, and then if you throw in any capital gain income, it reaches a whole new level. So I figured that would be interesting to show you how all of that works. So in any of these special situations, you will need to complete special worksheets and or additional forms to figure the amount of tax you owe, such as the foreign earned income tax and the qualified dividend and capital gain worksheet that are shown next. This is the foreign earned income tax worksheet, and we actually cover the foreign earned income exclusion in a couple of different courses. One is the course called the Foreign Tax Credit and Other Credits for Individuals, and we also cover it very early on in our season on wage and taxable fringe benefit. We talk a little bit about the foreign earned income exclusion there, where I do mention this foreign earned income tax worksheet, and today we are going to take a good look at it. This is the capital gain worksheet, and we've talked about this in a few of our courses, including basis of assets and sale of assets, sale of capital assets. So we're going to move on now and actually throw those two worksheets together to show you how there is an interaction. And I actually am working with a client right now who seems to be getting into these little tax nightmares because she moved to Singapore, and I've done her taxes for over 20 years. But since moving to Singapore, she seems to be talking to people who are residing overseas and getting information from them and then making some bad tax choices because she didn't talk to me first. And the first bad tax choice she made was she walked around under the assumption that because she was able to exclude her foreign earned income from taxation here in the United States, that she wasn't going to owe any tax at all on this foreign income. And there was a partial truth to that statement. There's a partial truth in that she can exclude the foreign income, but because she's excluding that foreign income, she is going to pay more tax on the income that is subjected to American tax. And the second thing that's gone on is she's actually gone a whole year now, this current year, where she hasn't worked at all. She decided to take a year off from work, and she decided to use this year to sell the home that she owns in Oregon. And she was under the impression that she would pay zero capital gain on the sale of her home in Oregon because she has no other income, and she's in the 0% tax bracket. And again, that is another partial truth. In order to pay 0% tax, you have to be in the 15% or lower bracket. But in her case, she's selling a home with a $200,000 capital gain, and you're not in the 0% tax bracket when you have $200,000 of income. So what's going on with her situation is really explained beautifully in this illustration that I'm doing here, and something that you can prepare your clients for if they start walking around under these same suppositions, and possibly even based on things that you could believe are true and even explain to your client briefly before actually delving in and really, really understanding the computations that are going on. So to explain how it all comes together, I've created a problem here for a character named Tom Taxed a Lot. He returned to his home in Vermont on May 2nd, 2014, after living and working for 3 years in New Zealand. He had $80,000 of wage income that he earned in New Zealand and another $60,000 of wage income that he earned in the United States. Tom also received a 1099 DIV that reported the following amounts: ordinary dividends of $10,000, qualified dividends of $8,000, and a capital gain distribution in the amount of $1,000. His federal return is attached, and when we look at his federal return, we can see on line 7 that he's reporting $140,000 of wage income, of which $80,000 is foreign earned compensation from New Zealand. We also show that he has $10,000 of dividends, of which $8,000 are qualified, and then we show $1,000 of capital gain distributions. Then on line 21, we enter negative $32,934 because he's claiming the foreign earned income exclusion, and he's not going to have to pay tax on this foreign income. So that reduces his adjusted gross income down to $118,066. We move over to page 2 of the form, and I haven't done anything complex like have him itemize deductions. I'm just giving him a standard deduction. I'm also giving him a personal exemption. So we arrive at a number on line 43, which is his taxable income. At $107,916, he's not going to be able to use the tax tables. He's going to have to use the tax computation worksheet to figure out how much tax he owes. But the thing is, even the tax computation worksheet is not going to get him where he needs to go. There's two reasons. One is he has capital gain income, and the other is that he has foreign earned income exclusion that is going to affect how his tax computations work. So in order to figure the tax, and the correct tax that he is going to compute is $26,959, we're going to have to do a little bit of work. So let's move over to the first worksheet that we need to look at. And here we have the worksheet called Foreign Earned Income Tax Worksheet for line 44. And we begin the worksheet by taking his taxable income from line 43 of his Form 1040. So this is line 43 right here, $107,916. That's the starting point. We enter that on line 1. Then it says, enter the amount of income you excluded under the foreign earned income exclusion. So we go back up and look at the 1040, and the amount of income he's excluding is this $32,934. So we've entered that, $32,934 on line 2. We add that in and figure out what his taxable income would have been if he'd not claimed the foreign earned income exclusion. So this already isn't sounding good. But there's an instruction here for line 3 that says, enter the amount from line 3 above on the qualified dividend and capital gain worksheet for Schedule D. So we can't go past line 3 and on to line 4 until we've done the capital gain and qualified dividend worksheet. So we're going to go down to the worksheet for calculating the tax on capital gains, and we're going to enter $140,850 on the line. Then it asks how much qualified dividend and how much capital gain income did you have. He had $8,000 and $1,000 respectively, so a total of $9,000 of his income is going to be taxed at a rate other than the ordinary rate. In other words, he's going to get capital gain treatment on that. So his income from line 1 is reduced by $9,000, and on line 7 we figure his ordinary income that's going to be subjected to tax. So this is the amount of non-capital gain income, and from line 7 to line 24, we're going to need to do some computations. And on line 24, this is the amount of tax on $131,850 of ordinary income as computed in Section A of the tax computation worksheet, which means I have to do another worksheet. So let's go over to the next worksheet. Here it is. And on this worksheet, we show the amount of taxable income that Tom Tax-a-Lot has. It shows that he's in the 28% bracket, just based on the income level shown here. And so we take $131,850, multiply that by 28%, and we get $36,918. And then the worksheet says subtract out the portion of income that would be taxed at lower rates would benefit you by reducing your tax by this much. So essentially, we're going to subtract out $6,824, and that leaves Tom with $30,094 of tax. So we go back after figuring that number, and we enter that on line 24. But we're still not done. Now we have to look at the $9,000 of income he has that's being taxed at the capital gain rate and figure the 15% tax on $9,000. When we do that, we have $1,350. And we're still not done, because now we have to give him the benefit of the foreign earned income exclusion, because he's not going to have to pay tax on the income he's excluding. But on the other hand, he's not going to save tax at his highest rate. Rather, he's going to save tax at his lowest rate, which is kind of a bummer. So he goes down to the tax tables again, and this time he looks up the amount of tax he's going to owe on the income that he excluded under the foreign earned income exclusion. And that income amount that he excluded is $32,934. He finds $32,934 on the tax tables, and you can see that if he were in a much lower bracket, if $32,934 were the only income he were earning, then he would be in the 15% tax bracket. So essentially, IRS is taking away his lowest tax brackets or giving him a credit for tax only using those lowest tax brackets. And so when we're done with this determination, we figure that the tax on the amount of income he excluded was $4,485. And we take that $4,485 and we go all the way back up to line 5 of the foreign earned income tax worksheet and enter it on line 5. So when we're finished, we have this tax that we figured under the qualified dividend and capital gain worksheet, which was the tax on all of his income, including his foreign income, plus the tax on his capital gains. We enter that on line 4. And then we subtract out the amount of tax that is attributable to income excluded under the foreign earned income exclusion, and we finally arrive at the net number that he's going to owe Uncle Sam, $26,959. So we go ahead and enter that on line 47, and that is the mystery solved on how we figure that tax. So what you're seeing in this computation here is that computations for the foreign earned income exclusion can make tax computations complex. And then when you throw into the mix the capital gain income, you reach a whole new level. Now, the reason my friend is having problems with her tax computations on the sale of her home, and she hasn't lived in it 2 out of the last 5 years. This is the problem. She's been gone for about 4 years now. Is this problem right here? It says enter $36,900 if you are single. And what this number here represents is the amount of income you can earn for the year that is taxed at 0%. And in the case of Tom Tax-A-Lot, he doesn't qualify for any 0% tax rate because his income is greater than $36,900, which means his tax bracket is high enough that he doesn't ever get a 0% rate. But even if you are in the 0% bracket and the only income you have is capital gain income, it's only going to be the first $36,900 of taxable income that's going to get that 0% rate, and then everything over that is going to get taxed at 15%. All right, so let's move on to the next topic, which is the alternative minimum tax. And I feel like I'm mentioning the alternative minimum tax just about in every other course I teach without ever actually getting into the meat of the matter. And that's because I reserve it for one course exclusively, which is understanding the alternative minimum tax. But since today's class is a class about other taxes, I feel I will give you another rundown on what the AMT is. And what the AMT is a tax that runs parallel to the regular tax, because ordinary income tax rules allow certain deductions and credits that are used to reduce the ordinary tax. But under the rules for alternative minimum tax, the credits and deductions you claim under the regular tax may be disallowed or delayed or changed in some way. So the AMT calculations running parallel to the regular tax determine if you're going to pay AMT. Most people don't pay AMT because their income is low enough that they never see it. And actually, if you're really rich, you don't pay it either. AMT really is a tax that under today's rules is specifically designed to target high middle income earners. And so if you are a high middle income person, odds are you're paying this tax. And by high middle income, I'm really referring to about between $150,000 and about $700,000 of income. If that's you, you're probably paying alternative minimum tax. So under the alternative minimum tax, certain deductions are taken away and certain deductions are delayed. And these deduction items are called adjustments and tax preference items. And the items that are taken away completely are the personal exemption deduction, the standard deduction, certain itemized deductions are taken away. Also, there are changes to how quickly you can depreciate property. There are differences between gain and loss rules, particularly when you're dealing with stock options, but also with qualified small business stock sales. There are changes in how passive activity loss deductions can be claimed. All in all, AMT is designed to do calculations in a different way than the regular tax. And if you fall into those income bracket parameters I told you about, odds are you're going to have to pay the tax, and you figure it using Form 6251. Next in line, we have the self-employment tax, and we've covered this tax in several of our other courses as well, not least of which was self-employment just this week. I covered that. But typically, you're going to be exposed to self-employment tax if any of the following apply to you, including you are self-employed, or you have income from farming, or you are an active participant in a partnership, or if you had 1099 miscellaneous employee compensation, miscellaneous non-employee compensation rather, or you are a church employee. If any of those apply to you, it's possible that you need to pay this tax. And then the next one in line is one we're going to be looking at for a little bit longer, which is the Social Security and Medicare tax figured on Forms 4137 and 8919. Now, the first of these is 4137, which is the Social Security and Medicare tax on unreported tip income. And we covered that in depth in our course called Wage Reporting, Fringe Benefits, and Other Income and the Foreign Earned Income Exclusion. So I'm not going to work on it here today, but suffice it to say that if you receive tip income and you do not report these tips to your employer, then you are going to need to file this form to pay the tax you owe. You would also need to pay this tax if your employer allocated tips to you on your W-2, unless you can show that you did in fact report all of your tips to your employer. The next one in line is figured on Form 8919, and we are going to spend some time on that today. It's called the Uncollected Social Security and Medicare Tax on Wages. And if you worked as an employee, your employer should have issued you a Form W-2 reporting total wages, salaries, and tips paid to you during the year. However, if your employer treated you as an independent contractor by issuing you a Form 1099 Miscellaneous instead, you can use Form 8919, Uncollected Social Security and Medicare Tax on Wages, to figure and report your share of uncollected Social Security and Medicare taxes due on your wages. By using Form 8919, your Social Security and Medicare taxes also will be credited to your Social Security record. Do not use Form 4137, Social Security and Medicare tax on unreported tip income, for this purpose. And actually, before we had 8919, I used to see people use 4137 for this purpose. I never did, because I knew that was a form for reporting tips, but people felt like, okay, you were given a 1099 Miscellaneous, and technically you're an employee, so you should have paid half the tax on your wages, and your employer should pay the other half, and the only form out there to do that is 4137, so I guess I'm going to use this. But up until Form 8919 came out, there really was no methodology for figuring the employee's share of tax owed on wages when a 1099 was incorrectly issued, and so I essentially would file a substitute W-2 with the return saying, hey, the employer should have issued one, didn't, and quite frankly, the way the laws are written, the employer is responsible for paying the Social Security and Medicare tax on employees' wages, and if they don't withhold the employee's share, they're still responsible for paying it anyway. And that worked beautifully for about 15 years, I suppose, until the IRS decided to come up with this Form 8919. And things are not as good, at least for my tax clients, as they used to be. I find 8919 has logic behind it on the surface, but the application is that none of my clients ever want to touch this form. And so ultimately, when they do get a 1099 Miscellaneous, when they should have received a W-2, I've not yet had a single client willing to file this form. They would all rather file and pay self-employment tax on the full amount than to file this form. So let's take a look at what the form is and why people might not like it and what the purpose of it is. And basically, to use Form 8919, you have to meet one of four criteria. The criteria include that you filed Form SS8, Determination of Worker Status, for purposes of federal employment tax and income tax withholding, and received a determination letter from the IRS stating that you are an employee of the firm. You received other correspondence from the IRS that states you are, in fact, an employee. Or you filed Form SS8 with the IRS and you have not yet received a reply. If you have not yet filed Form SS8 but believe you should be treated as an employee, you must file Form SS8 on or before the date you file your return. Do not attach Form SS8 to your return. Or you received a Form W-2 and a Form 1099 Miscellaneous from your employer for 2014, and the amount shown on the 1099 Miscellaneous should have been included as wages on Form W-2. Examples of amounts that are sometimes erroneously included on Form 1099 Miscellaneous that should be reported as wages on Form W-2 include employee bonuses, awards, travel expense reimbursements not paid under an accountable plan, scholarships and signing bonuses. Generally, amounts paid by an employer to an employee are not reported on Form 1099 Miscellaneous. Form 1099 Miscellaneous is used to report non-employee compensation, rents, royalties, and certain other payments. So if you are an employee and you received a 1099 Miscellaneous, there's a problem. And IRS says, yeah, you have a problem, and you need to file Form SS8 in most cases in order to treat the payment as wages. So let's take a look at Form 8919. Those four options that I just read through to you, they're actually listed on the front page of the form, right up at the top. Who must file this form? You must file Form 8919 if all of the following apply. You perform services for a firm. You believe your pay from the firm was not for services as an independent contractor. The firm did not withhold your share of Social Security and Medicare taxes from your pay, and one of the reasons listed below under the reason codes applies to you. So then we have reason codes. A, I filed Form SS8 and received a determination letter saying that I am an employee of the firm. Or option C, I received other correspondence from the IRS that states I am an employee. Or G, I filed Form SS8 with the IRS, but I have not yet received a reply. Or H, I received a Form W-2 and a Form 1099 Miscellaneous from this firm for 2014. The amount on the Form 1099 Miscellaneous should have included as W-2 wages. Do not file Form SS8 if you selected Reason H. So Reason H is probably the only reason that I might actually get a client to file this form. I just can't remember an instance where I've had it recently. But under Reason H, your client actually did get a W-2. that from the same employer that they received the W-2, they also received a 1099 miscellaneous. And that pretty much explains to the IRS that because the person got a W-2, they are in fact an employee, so this 1099 miscellaneous they're getting off on the side, that's not right. And so, yeah, go ahead and file Form 8919 and then treat that 1099 miscellaneous as wage income and use Form 8919 to figure the employee's share of the tax. So this is Form 8919 right here. It's used to compute the tax. There are two rates. There is the Social Security rate and there is the Medicare rate. And if your income goes over $117,000, then you max out on the Social Security rate and you are left paying only the Medicare rate. So let's talk about this SS8, because SS8 is really the reason why more people, in my opinion, aren't using Form 8919. Form SS8 is used by the IRS to determine whether or not you are an employee. And the courts have considered many facts on deciding whether a worker is an independent contractor or an employee. These relevant facts fall into three main categories: behavioral control, financial control, and the relationship of the parties. In each case, it is very important to consider all the facts because no single fact provides the answer. IRS Publication 1779, Independent Contractor or Employee, with a question mark, provides information that can be helpful in determining whether a worker is an employee or self-employed. If you are not sure whether you are an employee or an independent contractor, you should complete and submit Form SS8, Determination of Worker Status for purposes of federal employment taxes and income tax withholding. IRS Publication 15A, Employer Supplemental Tax Guide, provides additional information on independent contractor status. Form SS8 may be filed by a firm or a worker to request determination of the status of a worker for purposes of federal employment taxes and income tax withholding. The form must be submitted for a tax year in which the statute of limitations on the tax return has not expired, and the statute of limitation expires 3 years from the due date of the tax return or the date filed, whichever is later. And this is the comment that I made earlier. While Form SS8 appears on the surface to be a useful tool for establishing the true nature of an employee-independent contractor relationship, few employees are willing to file the form. Objections frequently cited by taxpayers include: they do not want to attract IRS scrutiny. The questions are far too probing. They do not want to aggravate their employer and risk losing their jobs. And finally, they do not want to create a problem for their employers even after employment ceases. I literally had a client, and this has been probably 3 years ago now. It was the closest I ever got to actually filing this form. They brought to me a 1099 miscellaneous. They had been working for this particular company. Their termination had ceased. They were not on good terms with the company. And when I interviewed them, it was abundantly clear that they met all of the definitions of being an employee of this firm, and they should not have been issued a 1099. So I said, you know what, if we file this as a 1099, you're going to owe self-employment taxes, which is going to be a boatload of money. But we could reduce it by half if we file Form 8919. Now, if we file 8919, you're also going to have to file Form SS8. And the client said, okay. So while they were sitting there, I filled out the SS8, interviewed them, got all of the information necessary to fill out SS8. I also filled out the 8919. I gave them a copy of it to take home and review, and they got cold feet. As soon as they started reading through all of these different criteria, it was just overwhelming for them and stopped and essentially paid the full-blown share of self-employment tax rather than filing this form. So let's take a look at Form SS8. And what's interesting about SS8, and I mentioned it earlier, is that the form can be filed by either the employer or the worker. So if you have a client who is a business and your business client is concerned about whether or not people they have performing services for them or working for them are independent contractors or employees, you can actually use Form SS8 to have IRS make that determination for them. If they think they're pretty sure they've got independent contractors and they're trying to make sure that they do have independent contractors because they don't want to have employees, then this form could be submitted to the IRS, and then IRS would come back and make a determination that they could then rely on. And the other side is that you've got a worker who's been hired, and that worker is being treated as an independent contractor. Maybe they want to be, maybe they don't want to be. What they want to be sure of is that they are being treated correctly. The worker can fill out the form. So the first step is to determine who is preparing the form or submitting the form. And then it goes on to ask general information of the worker or the firm. The total number of workers who are performing services, how did the worker obtain the job, etc. We then move on to more questions on general information. If the worker received pay from more than one entity because of an event such as a sale, merger, acquisition, or reorganization of the firm, provide information about that here. Then we move into Part 2, behavioral control. Provide names and titles of specific individuals if applicable. What specific training was given? How does the worker receive work assignments? Various other questions about their role at work. Financial control. Who controls the financial decisions of the company? Does the worker have any of their own equipment? Do they have control over their work schedule? Things like that. Then we move on to relationship of the worker and the firm. Please check the benefits that are available to the worker. Do they get paid vacations, sick pay, paid holidays, personal days, pensions, insurance benefits, bonuses, etc.? Go ahead and answer all of these questions out. And then we move on to Part 5, which is for service providers or salespersons. Complete this part of the worker provided a service directly to customers or as a salesperson. The questions in here are going to be more directed at establishing whether or not you have a category of worker called a statutory employee. And a statutory employee is someone who really works as an independent contractor but is an employee under statute. And in these situations, the worker actually files Schedule C, but the employer is still responsible for paying the Social Security and Medicare taxes and doing with the withholdings on those. So that is the Form SS8, and you can see from the level of scrutiny or information that it's asking for that it is asking questions that some people might find intimidating. And to this date, I have yet to have a single client file the form, even though I've yet to go through a single filing season where I haven't got a worker in front of me that I am fairly much certain qualifies for the form and would win if they filed it. The next line we're going to look at is line 59, which is the additional tax on IRAs, other retirement plans, etc. And we covered this line in depth in our course called Pension and Social Security Income. But suffice it to say, if you allow excess money to accumulate in a retirement plan, or if you take an early distribution from a retirement plan, or from a health savings account, or from an education savings account, you can be subjected to some additional taxes. And those taxes are figured on Form 5329, and then the amount of taxes entered on line 59. Next, we're going to move on to line 60A, which is the household employment tax line, and we are going to spend some time on this one. If you had a household employee during the year, you may be required to pay Social Security and Medicare tax for your employee. If you choose not to file Form 941 Employee Quarterly Federal Tax Return, you can file Schedule H for household employment tax and include the taxes owed with your personal return. Now, you are required to pay payroll taxes for your household employees if you pay $1,900 or more to any one household employee during the year, or you paid $1,000 or more in any calendar quarter of either 2013 or 2014 to all of your household employees combined. If you are an employer who is required to pay payroll taxes, you must apply for an employer identification number, and you must issue a W-2 to every employee to whom you paid $1,900 or more during the year by January 31st of the following year. And you must file Form W-3 and W-2 with the Social Security Administration by February 28. However, that is if you are filing paper. If you are e-filing, you don't submit W-3 because that is only attached to a paper submission of the Form W-2. As an employer, you are responsible for withholding and paying Social Security and Medicare taxes for your employees as follows. You should withhold 6.2% gross wages for Social Security tax and 1.45% for Medicare tax. You may also, if both you and your employee choose to, withhold income taxes from your employee. Note that if you fail to withhold Social Security and Medicare taxes, you must pay both the employer share and the employee share of these taxes. Employers who do not withhold must pay both the employer and employee share of payroll taxes, and it is the employer, not the employee, who is responsible for payment of this tax. And you will see how the employer is responsible for payment right on the Schedule H. It's right there in front of you. So wages paid to certain pensions or certain persons are not subject to the tax, though. So in most cases, if you have a household employee, you're probably going to have to pay household employee tax or payroll tax on your employee. But there are certain types of employees that you may have working for you where you won't have to pay the tax. And these include any of the following individuals: your spouse, your child who was under age 21, your parent with some exceptions, and an employee who was under age 18 at any time during 2014. If the employee was not a student, though, there's going to be an exception for employees who are under age 18. So let's take a look at these exception categories. If you employ a parent, you probably are not going to have to pay taxes on the amount that you pay to your parent to watch your kid, but there is an exception to that. You will include cash wages you paid to your parent to work in or around your home if both 1 and 2 apply to your situation. Number 1, your child who lived with you was under age 18 or had a physical or mental condition that required the personal care of an adult for at least 4 continuous weeks during the calendar quarter in which services were performed. And you were divorced and not remarried, a widow or widower, or married to and living with a person whose physical or mental condition prevented him or her from caring for that child themselves. That's the exception for parents. So normally if you pay your parent to watch your kid for a few hours, or even regularly, you're not going to have to pay payroll tax on them. But if the reason you're paying your parent to care for your child is because your spouse is incapable of caring for the child because of their own physical or mental condition, then you will have to treat your parent as a true employee and pay payroll taxes on them. There's also an exception for employees who are under the age of 18. Typically, if your employee is under the age of 18, you're not going to have to do the household employment tax on them. However, if the employee is under age 18, they are not a student, and providing household services is their principal occupation, then you still are going to need to issue them a W-2. And finally, cash wages. What is cash wages? Cash wages includes wages paid by check, money order, etc., but cash wages do not include the value of food, lodging, clothing, or other non-cash items that you give to a household employee. Estimated tax penalty. You may be required to pay a penalty if you owe $1,000 or more with your federal return. If you elect to pay your employee's taxes with your own return by filing Schedule H, you may need to either increase the amount of federal tax withholding from your wages where you work or pay estimated tax. So let's look at an illustration of how we prepare Schedule H. And in this illustration, we have a character named Julia. She employed a nanny to care for her 2 children, and she paid her nanny $12,000 during 2014. And during the year, she withheld $500 of income tax. She also withheld 6.2% Social Security and 1.45% Medicare tax from her nanny's pay. She also paid a state unemployment fund contribution of $144, and her EIN is shown here. Now, one of the things to bear in mind is that Schedule H is used to figure the payroll tax at the federal level, but virtually every state in the country that I'm aware of has its own local state payroll taxes that have to be assessed, particularly for unemployment tax. And so the Schedule H does nothing to address the state issue. And I can't really tell you what it's like in your state. I can tell you what it's like in the state of Oregon where I live. In the state of Oregon, there is an annual report that a household employer can file to make payments to the state of Oregon for this Oregon unemployment tax. Also, there are some local taxes that are assessed in some jurisdictions here in Oregon that can be paid with that annual report. And it could also be the case that you could run this nanny through a proper payroll service and have all the payroll taxes go out on the normal quarterly reports. But I just wanted to point out that if you have a client for whom you are figuring tax on Schedule H, keep your mind on the state issue because there probably is one. And you should look it up and take care of that, lest you appear to be less thorough than you should be. Let's go on and look at, after completing the payroll tax report, which she properly did, Julia is going to prepare and file Schedule H as follows. So we begin with line A and check the box that says, yes, did you pay any one household employee cash wages of $1,900 or more for the year? Absolutely, she did. So we go down to line 1, and on line 1, we enter the cash wages paid to this particular worker, and then we multiply those cash wages by 12.4%, which is the Social Security component, and we get $1,488. Next step, take $12,000 and multiply that by 2.9% to arrive at the Medicare tax component, $348. We then throw in the $500 of federal income tax that was withheld from Julia's pay, and we simply add these numbers up. $1,488 plus $348 plus $500 is $2,336. and that is the FICA component, the Social Security, Medicare tax, and income tax withholding portion of the taxes for Julia's household employee. And now we move on to page 2 of Schedule H, where we get into the state issues and the unemployment tax issues. In Part 2, we have the federal unemployment tax, or FUTA tax. You either figure that FUTA tax in Section A or Section B. If you timely filed reports with the state and paid the unemployment tax to the state, you complete Section A. But if you did not timely file or did not file at all the payroll reports for the state, you would complete Section B. And essentially, if you complete Section B instead of Section A, the computations for the rate of unemployment tax are going to be considerably higher than they are if you did properly file the state taxes. So on line 10, there's a series of questions on line 10, and assuming Julia completes and files her state unemployment fund form by April 15, 2015, the answer to questions 10 through 12 is yes. And since she answers yes to all of these questions, she's going to move on to Section A. And in Section A, we enter $144 because this is the amount that she paid to her state unemployment fund. And then on line 15, we enter $7,000. Although she was paid $12,000 for the year, the maximum federal unemployment tax that is owed on the wages paid to Julia's household employee is $7,000. So $7,000 of those wages are exposed to the FUTA tax, and the FUTA tax is actually a pretty small number, $42. So the $42 is added to the $2,336 figured on page 1 of the form, and on line 26 we enter the net tax that is owed, and this amount is going to carry over to her Form 1040 and get entered on the appropriate line, which is line 60A. Moving on to line 60B, this is the line used for repayment of the homebuyer credits. And there were a series of homebuyer credits offered in 2008, 9, 10, and 11. And the credit for 2008 is the only one that's really kicking around and causing any concern anymore. It applies only to those few people who are still out there that purchased a home in 2008 using the first-time homebuyer credit and have not yet either paid the credit back in full or sold the home. Well, if they've sold the home, they've had to pay the credit back in full. And so this particular credit was intended to be paid off over a series of 15 years, $500 at a time. But it gets paid back early if you sell the house, and you sell the house at a profit. The credits that were claimed in 2009, 10, and 11, those only needed to be repaid if you sold the house or stopped using the home as your principal residence within 3 years of purchasing the home and claiming the credit. Well, 9 is more than 3 years in the past, 10 is more than 3 years in the past, and 11, for 2014 tax purposes, is probably in the past. But it's possible if you did take advantage of the first-time homebuyer credit in 2014 and then you stopped using the home as your main home sometime in 2014, that you could still be sacked with repaying this tax. But this particular topic, because it's such a small number of people, I leave that entirely out of today's class. If you want to read a little bit about it, you can. But I do cover the computations and the details of how to figure the tax in a separate course that I teach called Sale of Home. If you want to know more about it, take my Sale of Home course. And we're now going to move on to line 62, which is other taxes. And if you are subjected to any of these other taxes, you're going to enter a code from the instructions in this space right here, and then enter the amount of additional tax you owe. Now, 2 other taxes are also entered on this line. They are the tax from Form 8959, which is the Additional Medicare Tax, and Form 8960, which is the Net Investment Income Tax. And you are going to have to pay these taxes if your income exceeds the threshold amount shown here for your filing status, and you have the type of income that these particular taxes target. So the 2 taxes that we're dealing with are the Additional Medicare Tax. That tax is 0.9% of the amount by which your wage income exceeds the amount shown here for your filing status. $200,000 for single, $250,000 for married filing jointly, and $125,000 for married filing separate. And the net investment income tax is 3.8% of your net investment income to the extent that your income exceeds the amount shown here for your filing status. So let's look at line 62A first, which is the Additional Medicare Tax. You are required to pay this tax if your earned income exceeds the base amount for your filing status. And we begin by looking at withholdings, because if you are being paid on a W-2 and your W-2 Medicare wages exceed $200,000, your employer is actually required to do additional Medicare tax withholding on the W-2. So an employer must withhold additional Medicare tax from wages that it pays to an individual if it pays that individual $200,000, well, more than $200,000 during a calendar year, and this is without regard to that person's filing status or to any other wages paid by any other employers. An individual may owe more or less than the amount of tax that was withheld by their employer, depending on whether that individual has a filing status, say, of married filing joint, or has other wages or other self-employment income that they received. So who owes the additional Medicare tax? Well, the tax is assessed when earned income exceeds $200,000 for a single filer or $250,000 for a married filing joint filer. Figuring the tax, well, it is 0.9% of the amount by which that filer's income, earned income, exceeds $200,000. And you figure the tax using Form 8959, and here's an illustration of how we compute that. Jake taxpayer is a single filer who received 2 W-2s reporting wage income for the year. Use the amount shown in boxes 5 and 6 to figure the amount of additional Medicare tax he owes. And you can see that the additional Medicare tax zooms straight over to box 5. I'm just going to zoom in a little and take a look at this box right here. See, box 1 is used to report wage income, but box 1 is reduced by salary deferrals to 401k plans. Medicare wages are not reduced by salary deferral to 401k plans, and so Medicare wages can be considerably higher than regular wages, and Medicare tax is due on Medicare wages, and the additional Medicare tax is due when the amount in box 5 exceeds $200,000. If you're working for an employer and under that employer your wages go over $200,000, then the amount shown in box 6 is going to reflect additional withholding for the additional Medicare tax. But in this case, we have a W-2 for less than $200,000, and because it's for less than $200,000, only the employee portion, that 1.45%, is withheld. And in this case, we have $20,000, so 1.45% of $20,000 is $290. I can tell you right now that there's no additional Medicare component in here. It has not been withheld. But because this worker's wages are over $200,000, and they have $20,000 where no additional Medicare tax was withheld, it means there's going to be a level of under withholding for this particular person, and they're going to have to make up for that on their tax return. So we go over to Form 8959 to figure the additional Medicare tax, and we begin by entering on line 1 the sum total of all of this particular worker's W-2s. And this worker had one W-2 for $267,500 and another for $20,000. You add those numbers up and you have $287,500. The next step is to find the threshold amount for his filing status, which is $200,000. We subtract that out and we have $87,500. The next step is to multiply that $87,500 by 0.9%. When we do that, we get $788. $788 is the amount of additional Medicare tax owed by Jake. But we're not done. Now we need to look to see how much withholding was done on Jake's W-2. And so we go over to line 19, and on line 19, we add up all of the Medicare tax that was withheld on this W-2. We have $290 on this W-2 and $4,486 on the other W-2. We add those two numbers up, and we put them on the line 19. Then we look at the total amount of Medicare wages that he had for the year and multiply that by 1.45% to figure out what the regular amount of Medicare tax he owes for the year is, and that's $4,169. Well, his withholding is more than his Medicare tax. The difference, $607, is the amount of withholding that went on to pay the additional Medicare tax. And this withholding is actually entered on the withholding line of his tax return. It carries to Form 1040 line 64 and is entered on line 64 of the 1040. The additional Medicare tax is entered on line 62 of the Form 1040. And of course, we check box A. Now let's look at the net investment income tax next. But I can see we're really due for a break. So why don't I give you a break, and when we come back from break, we'll pick up with net investment income tax and continue with Jake's illustration. Okay, welcome back from break, and we're going to pick up where we left off. which is a discussion of these additional taxes we have as a result of the Affordable Care Act. And we're now going to move on to take a look at the Net Investment Income Tax, or the NIIT tax. Individual taxpayers and trusts who are U.S. residents, have net investment income, and have income above the threshold amount for their filing status must pay an additional tax of 3.8% on the lesser of their net investment income or the excess of their income over the threshold amount. What taxpayers are subjected to the tax? Well, individuals will owe the tax if they have net investment income and also have modified AGI above the following threshold amounts. And we've already described them earlier. For most individuals who are single, that threshold amount is $200,000. If you are married, it's $250,000, and if you are filing a separate return, it's $125,000. Taxpayers should be aware that these threshold amounts are not indexed for inflation. And if you are an individual who is exempt from Medicare tax, you may still be subjected to the net investment income tax if you have net investment income and also have modified AGI over the applicable thresholds. Determining modified AGI for purposes of the net investment income tax, modified AGI is adjusted gross income from your Form 1040, line 37, increased by any foreign earned income exclusion, net of the deductions and exclusions disallowed with respect to the foreign earned income. So what is your net investment income? Well, in general, net investment income includes, but is not limited to, interest, dividends, capital gains, rental and royalty income, qualified annuities, income from businesses involved in trading of financial instruments or commodities, and businesses that are passive activities to the taxpayer, and investment income of dependent children reported on Form 8814. To calculate your net investment income, your investment income is reduced by certain expenses that are properly allocable to the income. But there is income that is not subjected to this particular tax, and that includes wage income, unemployment compensation, operating income from non-passive businesses such as partnership or S corporations, Social Security benefits, alimony, tax-exempt interest, self-employment income, and Alaska permanent dividends. Income that is included in the net investment income, well, to the extent that gains are not otherwise offset by capital gains, the following gains are common examples of items that are taken into account in computing the net investment income tax. Gains from the sale of stocks, bonds, and mutual funds, they are subjected to the NIIT tax. Capital gain distributions from mutual funds are also subjected to it. And the gain on the sale of investment real estate, including gain on the sale of a second home that is not a primary residence, and gains from the sale of interests in partnerships and S corporations to the extent the partner or shareholder was a passive owner. Investment income that is deferred, such as installment sale income, is included in the calculation of the net investment income tax in the year it is recognized for income tax purposes. There are some expenses that are not deductible, or there are expenses that are deductible when you compute the net investment income tax. That's why it's called the net investment income tax. And to arrive at your net investment income, gross investment income is reduced by deductions that can be properly allocated to the generation of that investment income. And examples of deductions that can be deducted against the net investment income include investment interest expense, investment advisory and brokerage fees, expenses related to rental and royalty income, tax preparation fees, fiduciary expenses, and in the case of an estate or trust, and state and local income taxes, and finally, state and local income taxes that are properly allocable to the net investment income. You can learn more about these particular deduction items by visiting the IRS's FAQ page at the link I've got here. But to really show you how all of it comes together, we'll continue on with our illustration with that character named Jake. So we're going to use the information I provided you on the earlier pages and continue on with the discussion here. In this case, Jake has investment income that includes $10,000 of interest, $10,000 of ordinary dividends, net rental income of $20,000, net capital gains of $10,000. So his gross investment income is $50,000. He had some expenses that he's going to be able to offset his investment income with. That includes investment interest expense of $1,000, State income tax he paid on his investment income of $4,000, and brokerage management fees totaling $2,000. So his total investment expense for the year is $7,000, and his net investment income, therefore, will be 50 minus 7, or $43,000. And we're going to use Form 8960 to figure his net investment income and the tax he owes on it right here. We begin in Part 1 of the form by entering his taxable interest. Then on line 2, we enter his ordinary dividends. Then on line 4, we enter his net income from rental properties, and on line 5, we enter the net gain or loss from the disposition of property, which is his capital gains. We total all of that up, and we have $50,000 for the year. We then enter the expenses he has. You can see there is a direct line for investment interest expense, state and local income taxes, and other miscellaneous expenses. We subtract those $7,000 of expenses out, and on line 12, we arrive at his net investment income. Does he have to pay tax on all $43,000? Well, we have to determine what amount by which his income exceeds the threshold amount for his filing status. So we enter his modified adjusted gross income on line 13, and that was $320,000 for the year. We subtract out the threshold amount for his filing status of single, which is $200,000, and we're left with a $120,000 spread. Well, his net investment income is more than the difference between his income and the threshold amount, so all $43,000 is going to be subjected to the net investment income tax. He's going to take $43,000, multiply that by 3.8%, and the result he gets is $1,634. The next step is to go over to his federal return, and on page 2 of the federal return, this is where we're showing his adjusted gross income. He had some itemized deductions. He also had an exemption deduction, just a partial deduction. His income's high enough that he's phasing out on it. And we arrived at tax of $67,910. We then moved down to line 62, and on line 62 we enter $2,422. That's the sum total of his additional Medicare tax that we figured on Form 8959, plus the $1,634 of net investment income tax we figured on Form 8960. And then we go over to line 64 where we enter the federal income tax withheld on his Forms W-2. And he had two W-2s, if you recall. He had one W-2 showing federal income tax withholding and another W-2 showing federal income tax withholding. So let's just bounce back up and take a look at those. Right here, you can see the first W-2 shows $75,000 of withholding. The second W-2 shows $5,000 of withholding. So the sum total of those withheld amounts is $80,000. However, when we did Form 8959, we determined that he has an additional $607 of withholding he's going to get credit for. So we're going to go back down to the 1040, and instead of entering $80,000, we're going to enter $80,607 as his withheld tax amount. Because he has two W-2s, he's also had excess Social Security and Medicare tax withholding. Actually, not excess Medicare tax, but he's had excess Social Security tax withholding on his W-2. And so on line 71, we enter the excess Social Security tax that was withheld. Ultimately, his withholding is far greater than his tax, and so he has a refund coming. The next line in line is line 62C. This is where you check the box and enter the code on the line to indicate the additional tax that you might owe. There are a number of different taxes. Most of these taxes have to do with recapture of credits. The only tax that I'm really going to even really mention is the additional tax on health savings account distributions. This tax is, if you're going to come up with any of these, this is one that might pop up that you have to deal with. And if you do owe that tax, you would enter HSA on line 62, check the box next to line 62C, and then figure the additional tax you owe on Form 8889 in Part 2. And I'll just describe this particular tax a little bit more. We cover it in detail in our course on pension and Social Security income. For HSA and MSA purposes, the additional tax on distributions not used for qualified medical expenses has increased to 20% for tax years after 2010. But you do not have to pay the penalty if your distribution occurs after you reach age 65, due to total disability or because of death. But if you are required to pay the tax, the additional penalty tax, complete Form 8889 and enter the code HDHP in the amount of penalty on Form 1040, line 62C. So refund or amount you owe, a number of important procedures apply when you are filing for a refund or calculating the amount you owe and making a payment. Now, one of the things that I've realized as a tax practitioner over the years is that my clients come to me expecting far more than just simple preparation of their tax return. Yes, they come in the door with armloads of receipts and tax documents that I need to sort through, and I have to identify what's deductible, what's not deductible, determine taxable amounts, fill out tax forms correctly. And one would think that after I've done all of that, my job is done. But in the mind of the client, the job is just begun. They have lots of questions about their refunds and if they owe, how they're going to pay their tax. And so this part of the course is actually a very important part of customer service because we're looking into the mind of the tax client and the things that really are concerning them that go beyond the scope of actually preparing the tax return itself. So we're going to spend quite a bit of time today talking about refunds, how you can get them issued, and also what happens when your client owes. What can you do to help them make the payments that they owe? And we're going to begin with refunds right here. If you have a refund, you're going to need to decide how you want to use and receive your refund. You may use your refund to purchase U.S. savings bonds or to pay estimated tax. You may have your refund mailed to you, or you can choose to have your refund deposited into one or more bank accounts through direct deposit. If you want to do direct deposit to a single account, you can do so by entering the routing number and account number on line 76 of your federal return. You can see it says line 76B, enter the routing number, indicate whether it's checking or savings, and then on line 60D, enter the account number. Now, you should carefully verify the accuracy of any numbers you enter on Form 1040 because if they are wrong, your client's refund is going to be delayed and they are going to be very, very unhappy. So let's talk a little bit about security measures that you could have in place to ensure that you don't mess this information up. And you're looking at a person who has had to deal with this particular issue being messed up. And it's not because I personally made an error, it's because I did not, as a business owner, establish procedures to make sure that my staff did not make errors. And in one tax season, I had multiple problems with refunds not getting to the accounts they were designated to. And some of it was my staff's problem, and some of it was just not understanding a particular banking situation that went on in that year. And that banking situation was that Wells Fargo bought out First Interstate, and in the process it gave new account numbers to all of its account holders. And it also used a separate routing number for Wells Fargo than it did for First Interstate. And so what happened was clients were coming in and saying, oh, I have a new account number, and handing us their First Interstate check because they were still using their old checks. And so we were matching Wells Fargo account numbers with First Interstate routing numbers, or we were using First Interstate routing numbers with Wells Fargo account numbers. But at any rate, one would have expected that Wells Fargo could have predicted there would have been a problem and either chosen to keep the same routing numbers and account numbers or made it abundantly clear to people that they shouldn't be mixed. In more recent years, Chase Bank bought out Washington Mutual Bank, and Chase Bank made a point of keeping all of the Washington Mutual routing numbers and account numbers identical. Nothing changed. So there could have been a lesson learned for everyone in the industry what came out of the fiasco that was First Interstate. But at any rate, I lived through that, and it was 20 years ago now that we were living through that, but it wasn't pleasant. As a result of the mismatches, where we didn't have the correct routing number and account number matching each other, clients' refunds were not making it into their account. And where were they going? Well, ultimately, they weren't put in the wrong account. That at least did not happen. But when the Iras sends a refund to a particular routing number, the bank who owns that routing number receives this electronic transmission of money that's supposed to get deposited. And then the bank uses the account number to figure out what account it goes into. Well, if it establishes that there's not a valid match between the account number and the routing number, in other words, the account just doesn't exist, the bank doesn't put any money in there. And instead what it does is it sends the money back to the IRS. And then the IRS, because it doesn't move quickly, sits there and kind of absorbs the refund for a while and sits on it and thinks about it and twitches its nose and eventually figures out that it's going to need to issue a paper check and mails a paper check to the client. Well, the time frame between when that refund was attempted to be deposited and the time that the client gets their money is probably a minimum of 8 weeks. And so 2 weeks after the client files, they're looking to receive their refund in their bank account, and it's not there because of this mismatch, and then the client has to wait literally an extra 8 weeks for that money to come. And if this is a client that's really relying on their money, they're going to be very, very unhappy. And I can remember personally writing checks off my personal account to front my clients' refunds to them until they got their refund from the IRS and could come back and pay me because they were so upset. And in 1 year, my client never came back and paid me. They got their refund from the IRS and kept it, and so I was literally ripped off. But this was a big, important issue to my clients. It was a big, important issue from a practice management thing. And so I, as a business owner, felt compelled to really evaluate security measures I could put in place or quality control procedures I could put in place in my office to prevent that. And so today, these quality control procedures that I put in place remain, and we have a very methodical way that we go about ensuring that the information our clients give us and that we enter on the tax return is correct. And so if I take a client's check, and this is an image of a check that IRS provides, just kind of a sample check, it helps to understand how checks are written. The first set of digits that appears on the check is always the routing number, and is always 9 digits long, and that is the number that is entered on the routing number. The second step is to determine, by looking at the check, what the account number is. And often the account number is broken up by little commas, and they may mean something to people in the banking industry. They don't mean anything to me, and they don't mean anything to the IRS, frankly, either. You drop these commas and you don't worry about them, and ultimately the account number for this client is 20202086. And then after the account number, you may see the check number imprinted on the check, and you identify the check number because it's going to appear in two places. It's going to appear at the bottom, and it's also going to appear in the corner. Unless they've just opened up an account, then the checks may not be numbered. Now, with Bank of America, I think they put the check number in between the account number and the routing number. So that's why you should really identify what the check number is and make sure you don't include it as part of the account number. I obviously ask to see a check. I don't allow my clients, if I can help it, to just rattle off what their account number is or read it off to me on their phone. I want to have a check. If it's all possible to get a check, I want that check. Now, in the modern age, a lot of people don't write checks anymore. They have debit cards, and they don't walk around with checks. And so they'll hand me a debit card and say, can you use this? And the answer is flat out no. The numbers that appear on debit card are useless. They cannot be used for setting up direct deposits. So then the next step will be to say, okay, well, did your bank give you a deposit card when you opened the account where they wrote down what that information was? And if they have that deposit card, I'll go run and make a photocopy of it and keep that for my records and use it. If my client can't give me a deposit card and they can't give me a copy of a check, then essentially I'm left with having them have to sign off on account information that hasn't been verified anywhere. And my practice will typically be to send them to their bank and say, have your bank verify that this information is correct, sign off on it, and bring it back, and then I'll use it. And you may think this information is a little bit, or this level of caution is overboard until you've been in a position where your client hasn't got their money and is mad at you and it's your fault because they didn't get their money. Now, I'm not the only one who's suffered through this. I'm sure this has happened multiple times with multiple tax services all over the nation. And in fact, I think it's relatively common enough that I actually watched an episode of Judge Judy not that long ago. And a client was suing his tax preparer because the tax preparer had entered the wrong information for direct deposit. And in this case, the client brought in a copy of their prior year return, and the tax preparer was instructed to use the routing number and account number appearing on that prior year return. And the tax preparer made a data entry error in copying that information off, and so the client had not received their refund. What interested me about watching this particular show was that the tax preparer had absolutely no clue what they should have done when the refund didn't get to their client. They should have gotten on the phone with the IRS, worked with that client and the IRS to get that refund to the correct place. And instead, this tax preparer just chose to say, well, I don't know what happened to the refund. This is your problem, not mine. And apparently, in this situation, it did not bounce back to IRS nor get reissued as a paper check. Perhaps it did end up in someone's wrong account completely. I don't know. But the client didn't have their money, and so there they were in front of Judge Judy, and it was pretty cut and dry. Judge Judy ruled in favor of the tax client, and the tax preparer had to pay up that client's refund. So this can be an expensive thing under liability issues, even if you think it's your client's problem and not yours. Obviously, Judge Judy thinks otherwise, and so do I. So we are simply being asked, or we are essentially being asked by our clients to act as their agent in ensuring they safely receive their refund. And so what do I do? Well, what I do is I first off ask for some method, visual verification of the account number. I then copy the information that is printed on the check into my software. Once it's in my software, I process the return or view the return and look at that account number as I've entered it on the tax return, and I copy it from the screen onto a piece of paper. And this is a form I've created for the specific purpose of verifying the account number. So once I've copied it from the screen onto the paper, then I staple my client's check or some other photocopies of a document showing what their account and routing number is, and I have them visually compare the information that I had entered in my computer to the information that's printed on their check, and I have them sign off that it's correct. And I send them home with that particular piece of paper, which also describes that if it's incorrect, the refund will be delayed and blah, 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 blah. Since I've implemented that procedure, I've only had a problem once. And the only time I had a problem was when my preparer did not follow procedure. So as long as my preparer follows this procedure, things go quite well. But even internally within our company, we actually have a third step. The first step is I enter the information from the check and then copy the information from the check onto a piece of paper. The second step is I have my client verify that the information is accurate. The third step is that there is another person in our firm who independently, again, compares the information on the check to the information in the computer. And believe it or not, despite these other checks, this third person still does occasionally catch errors. But since we've had this system in place, it has prevented these types of errors from happening. So let's move on then to just one note here on the next page of the manual where it talks about credit unions. You should know that the numbers that appear on credit union checks may or may not be accurate. The beauty of credit union checks is you just never know whether the number on the check can be relied upon or not. Some credit unions act just like banks do. Whatever is on the check is golden. That is the client's account number. With other credit unions, the number that appears on the check may or may not be the account number. And when you call the credit union to ask them what they want you to do, they may say, we want you to drop the first 10 zeros and just use the last 5 digits, or they may say use all of the numbers on the form, or they may say use all of the numbers on the check but drop the last digit and change it to a 2. Crazy stuff. So whenever I'm dealing with a credit union, I call the credit union to verify that the information that appears on the check is the information that I should be using. And if it is not the information that I should be using, I figure out what I should be using. Now, it is possible to have your refund go to more than one account. In other words, split the refund into 2 or more accounts. If you want to split your refund into 2 or more accounts, you use Form 8888. And 8888 is also used to have some of your refund or all of your refund used to purchase Series I bonds. And let's take a look at Form 8888 right here. You can see it provides space for entering up to 3 accounts where you could have your refund go. And then in Part 2, you indicate if you want to see any part of your refund used to purchase Series I savings bonds and the name of the person to whom you wish to have the bond issued. Once you have filed your return, you can call the Treasury Retail Securities site to check on the status of your bond issuance. And then in Part 3, you indicate how much, if any, of your refund you want to see issued to you as a paper check. And then in Part 4, we have a total allocation of the refund. And essentially, Iras wants to make sure there's no addition errors, that if you've allocated a portion of your refund to one account, a portion of your refund to a second account, a portion of your refund to a third account, and also used a portion of your refund to buy Series I bonds, that the sum total of all of these lines is the same as the amount entered on line 8, and that the amount on line 8 is the same as your refund. So it's just a computational across balance section of the form. Now, let's move on to refund offsets. Let's suppose you've done everything correctly. You've got the correct account number entered in, your client has verified the account number, you've done the tax return correctly, but they still don't get the refund. And the reason they didn't get it is because it's been snagged. It's been offset to pay a debt that they have. Past due financial obligations can affect your current federal tax refund, and the Department of Treasury's Financial Management Service, or FMS, which issues IRS tax refunds, can use part or all of your federal tax refund to satisfy certain unpaid debts, including federal or state income taxes and child support or student loan debt that was submitted for offset. You will receive a notice if an offset occurs, and the notice will include the following information: the original refund amount, your offset amount, and the agency that received the payment and its contact information. If you believe you don't owe the debt, it's too late. IRS took it and sent it. And you are really left dealing with the agency that submitted the debt for collection. And you're really going to have a hard time if that's happened. There is one way that you can receive relief from these offsets if you can show that you are an injured spouse. And in that case, your refund was taken to pay a debt owed by your spouse that is not owed by you. And for that, you can submit an injured spouse allocation. Many refund offsets are applied to joint returns where only one spouse owes the IRS taxes or the FMS debt. An injured spouse is an individual who files a joint return on Form 1040, and all or part of the tax refund overpayment was or is expected to be applied against a debt of one spouse's past due federal tax account, child support or spousal support, federal non-tax debt, or a state income tax obligation. An injured spouse can work to protect and receive his or her share of the joint overpayment when certain conditions are met, and if he or she files Form 8379, the Injured Spouse Allocation Form. In order to qualify for the form, the injured spouse must meet certain eligibility requirements, including they filed a joint return for the current year that the refund garnishment is happening on, and the injured spouse is not required to pay the past due debt amount, and the injured spouse has or will report income such as wages, taxable interest, unemployment compensation, or the injured spouse will report payments such as federal income tax withholding from wages or estimated tax payments, or claim the earned income credit or other refundable credits. So let's take a look here at Form 8379, Injured Spouse Allocation. It is a form that I've filled out numerous times over the years. Not the most common one, but common enough. Form 8379 is used to apportion the following items between the injured and non-injured spouse, including income, deductions, dependents, tax credits, and withholdings. Form 8379 should be filed when the taxpayer becomes aware that all or a part of their share of a refund overpayment was or is expected to be applied or offset against their spouse's legally enforceable past due obligations. And Form 8379 needs to be filed for each year that the injured spouse meets this condition and wants their portion of any offset refunded. Now, the IRS frequently deals with invalid filings of Form 8379. In other words, people think they should file the form, and so they file it when they don't qualify for the form and the form is not necessary. Common incorrect filings include an individual files Form 8379 when he or she is not filing a joint return. If you're not filing a joint return, you're not an injured spouse. A debt does not exist at either IRS or FMS. Your debt must be with IRS or FMS in order for your refund to be used to offset it. And the taxpayer owes a personal debt, such as a utility bill. The IRS will not offset a refund because of a personal debt. If Form 8379 is filed for an invalid reason, it delays issuance of the refund and creates chaos for everyone, so don't do it unless you are able to use it. And so IRS actually revised Form 8379 in recent years, and really one of the reasons for the revision was to ensure that the people who fill the form out go through a series of criteria checks to ensure that they're actually filing the form correctly. But once you establish that you are able to file the form, it can be filed either with a joint return, including a paper or electronically filed return, or it can be filed separately from the return itself after the offset has occurred. So let's look at how the form is filled out. You complete Part 1 of Form 8379 to determine if you are an injured spouse. You complete Part 2 of the form to tell the IRS which tax year you are requesting relief for, and you complete Part 3 of the form to allocate income and deductions between you and your spouse. The form can also be filed if you live in a community property state. Even if you're not filing a joint return, if you are filing separately, community property rules can impact you and cause you to need to file the form anyway. Issuance of the injured spouse's refund. Part 2 of Form 8379 allows you to request that the injured spouse's portion of the refund be mailed to a different address. But since the information entered on Form 8379 does not change the address of record, requesting the injured spouse's refund be mailed to an address different than the address of record can cause delays in the refund. So Iras really says you should file Form 8822, change of address, rather than completing Part 2 of the form. So let's look at an illustration of how we complete this form. We have two characters, Al and Peggy Bundy, who are married, and they have two children, Bud, age 13, and Kelly, age 10. They're going to be filing a joint return. And Al works as a shoe salesman and received a W-2 reporting $30,000 of wage income for the year. Peggy is a homemaker, and she had no income of her own. She attended a hairdressing academy back in 2008, where she incurred $5,000 of student loan debt. She has defaulted on her payments. And during the year, she received information that her debt had been transferred to the FMS collection system and that Iras would begin garnishing her refund. Understandably, Al is upset about this, and he does not want to see his refund used to pay Peggy's student loan debt. He's going to prepare Form 8379 to save his refund, and this is how it's done. So we begin by preparing the tax return for the Bundys. And we can see we've got a joint return because that's the first requirement. A joint return is being filed. We've got the two kids being listed, and Al is the sole source of income. It's not necessary that he be the sole source of income. Peggy could have income, but in this situation, we've put all the income on Al. And then we show the deductions, we show the exemptions, and when we're all said and done, we arrive at a tax liability of only $181 for this family, and that tax will be offset by the child tax credit, so his net tax liability is zero. He had $2,000 of federal tax withheld. He's entitled to a $4,035 earned income credit and an additional child tax credit in the amount of $1,819. So Al has this $7,854 refund, and he does not want to see $5,000 of it used to offset and pay Peggy's student loan debt. So the solution is to prepare this injured spouse form. And on the injured spouse form, we begin by answering the series of questions to determine if Al meets all the tests to be considered an injured spouse. And the bottom line is that he is an injured spouse. And on Part 2, on line 10, we identify Al as the injured spouse, and we indicate that Peggy is not the injured spouse. Next, we move on to Part 3 of the form, and Part 3 of the form breaks down the income or does the allocation of the income, taxes, exemptions, and credits between the injured spouse and the non-injured spouse. And it works in a way similar to how you would be computing these items if the filers were filing separately. But Al would not want to file separately. If he were to file separately, he would lose the earned income credit. So that's not a good deal for him. He wants to keep his earned income credit. So he's going to file a joint return, but then do this injured spouse allocation. And in column A, he shows the amount of income on the return, and in column B, he shows how much of the income is his and how much is Peggy's. $30,000 to him, $0 to Peggy. He also shows the standard deduction. Well, under the standard deduction, 50% is attributable to him and 50% to Peggy, so he breaks that down accordingly. For the exemptions, we're going to give the children to Al, but Al can't take credit for Peggy's exemption, so he is going to enter 3 exemptions in his column and 1 in hers. We then have credits. We're going to give all of the child tax credit to Al, and we're going to show the federal income tax withholding and apply that to Al as well. Now, there's nowhere on here to ask you to show the earned income credit or any other special amounts that might be allocable to Al. Ultimately, Iras is going to do those calculations on their own and determine how much refund to give to him. So the form itself is not used to figure out what his share of the refund is. It's just used to show what his share of the income, withholdings, deductions, and credits will be. Next, we're going to look at amount you owe. So we've looked at what to do to preserve a refund or get your refund delivered to you. But now let's look at the next category of filer, which is someone who owes. You've gone ahead and prepared their tax return, and it is not a refund story. It's a you owe story. And a lot of times, clients are really troubled about how they're going to pay what they owe. Lots come in and they're pretty much prepared for it. They were expecting to owe. They've got the money set aside and they're going to pay what they owe. But sometimes it comes as a surprise that they owe as much as they do, or even though they knew they were going to owe, they don't have it set aside and they can't afford to pay it. So we're going to talk today about how you pay tax that you owe, but we're also going to talk about what to do if your client can't afford to pay what they owe. So if you have a balance due with your return, you can pay the amount you owe in any of the following ways. Through direct debit to your checking or savings account. Just at the time you file, you tell the IRS you want to have a direct debit come out. You can also do it through the electronic federal tax payment system called Ef Tps. This system requires some advanced setup, though, and it's not typically used by people who don't own businesses. You can also pay by credit card, but if you do that, there's going to be a merchant fee that's going to apply. And finally, you can do it the old-fashioned way by putting a check in the mail. Now, if you decide to mail a check, the IRS would like you to include Form 1040-V. 1040-V enables them to more precisely match the payment that is enclosed with that form to your specific name, Social Security number, and tax liability owed, the tax year for which you owe it. The IRS strongly encourages the use of Form 1040-V, but there's no penalty if you don't use it. There's also direct pay, and this is a relatively new service, brand new. I think the first year you could use this particular method to pay your tax was 2014. And this service allows you to pay your tax or make an estimated tax payment directly from your checking or savings account at no cost to you. You can click this URL here and go online, and then you follow these steps. You provide your tax information to the IRS, you verify your identity, you enter your payment information, you review and electronically sign the transmission, and finally you print a copy of the transmission for your records with the confirmation number to show the amount and date that you made this payment. I had a client this year who somehow got in here and managed to mess things up. I don't know what she did or how she did it, but ultimately she just wasn't able to complete the transmission. She got locked out of the system and finally had to resort to mailing a check, but it was a big frustration to her. So my advice for clients would be make sure you have a copy of your tax return with you at the time you log in, and make sure you have a copy of your check handy so that you can show how, that you have all the accountant information necessary to make this setup work correctly. The next item we're going to talk about is paying through Ef Tps. If you are going to use Ef Tps, you need to provide routing and account numbers for the financial account that you are going to use to make payments. Ef Tps is a system that is used by employers to pay payroll taxes, but it can also be used for other types of payments. And it's a pretty sophisticated system. It actually works really well. But in order to use the system, you really need to initiate the transaction at least a day before the day you want to have the payment come out. And actually it says you need to schedule payments 2 days to 120 days out in the future. So if you owe the tax today, you don't go in today and initiate payment. That's not fast enough. Payment by credit card. This one's real popular. Clients are always asking if they can pay by credit card because they want to rack up those air miles. But air miles really rack up at a rate of about 1% of the amount you're charging, and the fee for using these cards is usually higher than that, twice that normally. When you are a consumer and you go into a retail store and you pay for an item with a credit card, you swipe that card and you pay the sticker price of the item, but the vendor ends up paying a fee to the credit card company for the privilege of having that credit card transaction happen. Well, the IRS is not willing to pay that transaction fee. And so if you pay by credit card, you're going to be required to pay more than the amount of tax you owe. You're going to be required to pay the amount of tax you owe plus the credit card's fee plus the flat fee if it's a debit card. And so I pretty much discourage clients from using their credit card if they can't have to. But if they are going to use a credit card, there would be no reason to go for the more expensive providers. There's one here that's as high as 2.35%. It kind of seems like a no-brainer. You'd use one of the 1.87% providers. And if you're paying with a debit card, you'd obviously want to go for the cheapest provider out there, which is this one. Options for filers who cannot afford to pay. Your balance due is subject to interest and monthly late payment penalty if you cannot and do not pay by the due date of your return, not including extensions. Penalties are also assessed for failure to file a tax return. Therefore, you should file immediately and on time, even if you can't pay your balance due in full at the time you file. Many taxpayers are not able to pay the amounts due with their return, and the IRS does offer taxpayers the opportunity to make payments over time through something called an installment agreement. And if your client needs to set up an installment agreement, it can be done with Form 9465. It can also be initiated online. 9465 is one of the only forms that I give my clients for free. I make sure I charge a reasonable amount for virtually every form I prepare for my clients. That's how I make a living at my business. But when it gets to the issue of that they owe and they can't afford to pay, I figure I'm done. I'm going to give them one free service, and that is helping them request an installment plan from the IRS. And so this Form 9465 is one I fill out all the time. And the form can be filed electronically with the return, or it can be filed after the return has been filed or separately from the return. When you file Form 9465, you essentially tell the IRS how much you'd like to pay with your return and how much you would like to pay in monthly installments. And you can use the form to set up an installment agreement plan as long as you owe $50,000 or less in combined taxes. So the limits on it are quite high. But if you decide you want to pay in installments, you are going to have to pay a user fee, and the user fee is $120. Now, you can get a reduced user fee if you do electronic funds withdrawal, in which case you would only have to pay $52 to set up the plan. And if you are a person who has income below 250% of the federal poverty limit, you may also qualify for a reduced user fee of $43. If the IRS does not say that you qualify for the reduced user fee automatically, you can request a reduced user fee by filing Form 13844. If you need to restructure or reinstate your installment agreement, you may have to pay a reinstatement fee, and that is $50. The fee applies regardless of the income level or the method of payment. Guaranteed availability of the installment agreement, the IRS must agree to accept the full payment of your tax liability in installments if, as of the date you offer to enter into the agreement, your taxes do not exceed $10,000. And in the last 5 years, you and your spouse, if the liability relates to a joint return, have not failed to file any of the required income tax returns you need to be filing, or failed to pay any tax shown on any of those returns, or entered into an installment agreement for the payment of any income tax. And you can show that you cannot pay the income tax in full when due. The tax will be paid within 3 years, and you agree to comply with all tax laws while your agreement is in effect. Once the IRS agrees to help you set up an installment plan, you can expect to receive a monthly bill, and you must meet each payment on time or the plan will be rescinded. How do you make payments? Well, you can make payments in in about 3 different ways. You can do so by mailing a check on a monthly basis. You can have a direct debit option where it comes directly out of your bank account on a monthly basis. And you can also set it up with direct payroll deductions, which would involve some work with your employer. The employer has to submit a form, and then they can do backup withholding or additional withholding on your payroll. This is the form itself that is used to set up the installment agreement. And you can see that space is provided on the form for entering the routing number and accounting number so that payment can be made. Up in the top portion of the form, it asks for your name, your address, your Social Security number, where you live. It wants to know where you bank. It wants phone numbers, places that it can call you. And then it wants to know how much you owe with the tax return, how much you plan on paying with the tax return. Sometimes my clients can afford to pay something by April 15th, and whatever they can afford to pay, we enter on line 8. And then line 9 is going to be the difference. And then on line 10, we enter the amount that they want to pay each month. They need to pick a date between the 1st of the month and the 28th of the month because February does not have a 29 or 30 most years. So IRS doesn't allow 29, 30, or 31 to be choices. It has to be between 1 and 28. There's another PEP plan out there as well. So if you don't want to use the installment agreement plan, you can actually do an online payment agreement application. It works similar to the installment agreement, except that you do it online. And the system allows you to self-qualify for and apply for a payment agreement, receive notification of approval, and arrange a payment schedule. There are also procedures in place for people who owe more than $50,000. But if you owe more than $50,000, you're going to have to submit some extra documentation and do some extra legwork. This is a cutout or a cut and paste of the IRS website that you will land on when you are applying for an online payment agreement. And you can see that the setup fees that it assesses are the same as those fees that are charged for an installment agreement. They're essentially the one and the same. And the system availability, when you can go on and use the system, and what happens if you don't qualify for the agreement. There's also something called a partial payment installment agreement plan, and this type of plan is for people who just simply can't afford to pay even in installments. I haven't done many of these over the years, but I did do a couple of them early on in our recession, at the start of the recession, 2008, 2009. They were both real estate agents. The bottom they had nothing. I mean, their income went from really good to nothing. And both of them owed considerable amounts of money, not a prayer of paying it off anytime soon. And so we actually asked for a partial payment installment agreement, and ultimately their balances owed went into uncollectible status. But when you're in uncollectible status or involved in a partial payment installment agreement, there is a review that goes on every 2 years. And during that review, it's determined that you can begin to start making payments. You start to make payments based on the income that you have. To apply for a PPIA, you need to complete Form 433A or 433B. These are essentially statements that you file with the IRS to describe any of the assets that you own, what your liabilities are, and how much it's costing you to live. And if IRS establishes that based on your income, the assets that you have, and how much you need to live on, that you really have nothing to give them, that's when they're going to send you into uncollectible status. If they can see you're able to give them a little bit, then based on what they establish is that little bit, that's the amount that you're going to need to pay, even if it's less than the overall amount that you need to be paying. If the IRS determines that you could pay them by selling assets, they're going to make you sell some assets. But if you can show that you need those assets for income production, they'll still allow you to keep them. Now, the next category we have is innocent spouse relief. Innocent spouse sounds a lot like injured spouse, but it is nothing the same as injured spouse. And my effort today will be to help you really delineate in your mind the difference between innocent spouse and injured spouse. We just saw an example with Peggy and Al Bundy of when we have injured spouse. Let's compare that with innocent spouse. Innocent spouse occurs when the taxpayer has been told by the IRS that they owe money due to a past obligation with their former spouse, even their current spouse, but it's an old obligation having nothing to do with the current year. But because of this obligation from an earlier year, the IRS is after them. And I'll give you an example. I had a number of clients where I've helped them with this. It's been a long time since I've done an innocent spouse claim, but when I did it, I was successful. It was interesting how it worked. So I had a client who was a teacher, and her spouse abandoned her, left her with her 3 kids, head of household she was, and she'd never done a tax return in her life. Her spouse that abandoned her had always taken care of the finances. She just went to school, taught classes, took care of the kids, and he abandoned her. So she came in and needed to get her taxes done and sat herself in front of me. And this was really my first year as a tax preparer. This is how far back it goes. We're talking 1994 that I helped this woman. And I prepared her tax return for that year. She was head of household with 3 kids, itemized deductions. She had a nice refund coming. And sometime later she came to me with a letter from the IRS. She hadn't received her refund. It had been garnished, and it had been garnished to pay this old debt of her husband's. And in interviewing her, I decided I needed to call the IRS. And I got the IRS on the phone. We were talking and determined that what had happened was she had filed a joint return with her husband in an earlier year. The husband had prepared that return and had not prepared it accurately. He'd left off money. He was a fisherman, and the money he'd left off was his fishing boat income, subject to self-employment tax and the whole caboodle. But her income had been properly disclosed. So it was established that she didn't owe this money. The IRS agreed that she was a victim and qualified for innocent spouse relief. But back then they didn't have a form, so we had to write out a letter, explain all of the intricacies of what happened in the relationship, the fact that he had abandoned her, and ultimately her refund was released and she was never bothered by the IRS again. Well, since then, IRS actually has developed a form. It's still a relatively recent form, Form 8857. But let's talk a little bit about the background of the form and who can use it. In certain situations, the IRS may commence collection procedures against the taxpayers for tax debts owed by the taxpayer's spouse or former spouse. If the IRS is attempting to collect taxes which you believe you do not owe, you may qualify for innocent spouse relief. Firstly, let's discuss a concept which is joint and several liability. When you file a joint tax return, the law makes both you and your spouse responsible for the entire tax liability, and this is called joint and several liability. Joint and several liability applies to the tax liability you show on the return and to any additional tax liability that the IRS determines is due, even if the additional tax is due to income, deductions, or credits of your spouse or former spouse. Now, a divorce decree does not supersede the law. You remain jointly and severally liable for taxes, and the IRS can still collect from you even if you later divorce, and the divorce decree specifically states that your former spouse is solely responsible for this tax. And this happens a lot. I have clients come to me regularly who have had their refunds garnished, and the divorce decree specifically states that their spouse is liable for that debt. And the IRS says, we don't care. Unless you're going to meet the conditions for innocent spouse relief, you owe it. We really don't care what the divorce decree says. And if you have a situation where that's happened to your client, ultimately your client's left pursuing their former spouse to force that spouse to repay them for the money that they've been garnished by IRS. So it's a pretty nasty business. Don't ever think for a second that your client's divorce decree is going to protect them from an IRS garnishment, because it doesn't. Now, if a spouse was abused or lacked financial control, there can be some additional relief. And the IRS announced in Notice 2012-8 that it will use proposed new procedures to expand how it will take into account information when it is looking at a spouse who was abused or lacked financial control, and those provisions are now actually built into Form 8857. So let's take a look more at who might qualify for this relief. In some cases, a spouse or former spouse will be relieved of tax, interest, and penalties on a joint return. 3 types of relief are available to married persons who file joint returns. They include innocent spouse relief, separation of liability relief, and equitable relief. Married persons who did not file joint returns but who live in community property states may also qualify for this relief. You must request relief within 2 years after the date on which the IRS first began collection activities after you or against you after July 22, 1998. You may qualify for innocent spouse relief if you signed a joint return and the IRS has determined that the tax is owed on the joint return because the return showed tax was due and not paid, or the IRS has amended a return that understated the amount of tax owed, and you can show that the understated tax is due to an erroneous item of your spouse or former spouse, that at the time you signed the return you did not know and had no reason to know that there was an understatement of tax, and taking into account all the facts and circumstances, it would be unfair to hold you liable for the understated tax. Erroneous items are any deductions, credits, withholdings, or payments that are incorrectly restated on the return, and any income that is not properly reported on the return. Let's look now at the form itself. I haven't got an illustration with it filled out. I think it's kind of self-explanatory and it would take quite a bit of time, but I will look at a few of the lines. You can see, firstly, it goes into who should file the return. You go through a series of questions to see if you think you should be filing the form. And then in Part 2, it says, tell us about yourself and your spouse for the year that you want relief. In Part 2, continued, it asks for more information about your marital status, when certain events occurred. It also wants to know what level of education you have. Obviously, the higher the level of education, the more aware you should be of what's going on. But you can see my first client where I got innocent spouse relief had a university education, and she was still granted relief. And then it asks, were you involved in finances or preparing the tax returns? And if so, how were you involved? In Part 3, it says, tell us how you were involved in the finances, and asks, were you not involved in preparing the tax returns, or did you physically help prepare the tax returns? Did you even sign the return? Part 4 is where you describe more about your financial situation. It's a very long form. And then in Part 5, we get to the part where I was thinking about, complete this part if you were or are now a victim of domestic violence or spousal abuse. It goes on to say that if you are answering any of these questions, information that you are providing about yourself is not going to be revealed to your spouse. because it is confidential. However, the fact that you are filing an innocent spouse claim means that your spouse will automatically be informed of the filing so that, as they are entitled to under the law, have an opportunity to object to the filing. If ultimately you need to go to tax court, information about your personal situation could be released to your former spouse or your spouse unless you ask the tax court to withhold it. So there's a rather important paragraph here. And then it goes on to ask if you lacked financial control or if you were abused, go in here and describe the reasons for that. So just to wrap this up, I wanted to do a comparison between injured spouse and innocent spouse because people do get them confused. While similar in name, innocent spouse and injured spouse provisions have very different applications. It's helpful to remember that injured spouse Form 8379 is used to protect the refund due on a joint return, whereas innocent spouse files Form 8857 to stop Iras collection procedures for tax owed on a joint return or, in certain cases, community income on a separate return that was filed in an earlier year. As a reminder, injured spouse relief applies when a married couple files a joint return with a claim for refund and one spouse, the non-injured spouse, owes a debt to the IRS or to another agency collected on through FMS, and the other spouse, that is the injured spouse, does not have a debt with IRS or another agency collected on through FMS, and the refund shown on the joint return is due to the injured spouse's share of income credits and withholdings, and the injured spouse's refund will be used to pay the debt of the non-injured spouse. In this situation, the injured spouse files Form 8379 to protect and receive his or her share of the refund shown on the return. So we're at the top of the hour and due for our second break of the day. I'm also going to give you a password. And let me give you the first password of the day. Password number 1 is Stovokor, Stovokor, Stovokor. So welcome back from break, everyone. While we were on break, I threw up a question from the Iras C exam, which is the enrolled agent exam, and it has to do with the household employment tax. And the question says, in which situation would Janice not be required to file Schedule H, household employment taxes, for the year? So just read through that for a second for me and tell me what you think the correct answer is. A, paid $1,200 to her sister for babysitting in Janice's home in July, August, and September. B, withheld $100 of federal income tax payments from her yard worker. C, paid $2,000 to her mother for housekeeping. Or D, paid household help other than her mother $1,000 for the period of July, August, and September. In which of those situations would we not have to pay household employment tax? All right. So one of you did get the correct answer. Let's pull up the answer key here. And I actually did cover this in the class. We talked about people for whom wages paid would be exempt from the household employment tax, and one of those was a parent. And that is why item C is the correct answer. For purposes of filing Schedule H, do not count wages you paid to your spouse, your child who is under the age of 21, or your parent, with an exception, as Social Security and Medicare wages, even if these wages are $1,800 or more for the year. So you can refer to the instructions in Publication 926 for wages not counted. All right. So before the break, we were talking about innocent spouse versus injured spouse, and now we're going to move on to paying estimated taxes. Estimated taxes are one of those necessary things that some people need to do. Quite a few taxpayers need to be paying estimated taxes. And really, each year when you prepare your client's return, you're getting to a point where they owe, break even, or have a refund. And it is possible to pay a penalty for underpayment of estimated tax even where a client has a refund. So the IRS devotes quite a bit of time in Pub 17 to discussing the rules for estimated taxes, and there's a line on the tax form devoted to entering a penalty for underpayment of estimated taxes. So it's rather an important area, even if it's not a glamorous area, to figure out. So let's talk about that next. The law imposes penalties and interest on filers who pay their taxes late. While it is possible to pay your taxes at the time you file your return, you can be penalized if you owe more than a certain amount when you file your return. So who must pay estimated tax? Well, estimated tax rules apply to both U.S. citizens and resident aliens, as well as residents of Puerto Rico, the Virgin Islands, Guam, the Commonwealth of the Northern Mariana Islands, American Samoa, and also to non-resident aliens who would use Form 1040 ES&R. There is an exception, though. You do not have to pay 2014 estimated tax if you were a U.S. citizen or resident alien for all of 2013 and you had no tax liability for the full 12-month 2013 tax year. Well, if we're looking forward to 2015, we would simply change this to say 2015. You're not going to have to pay estimated taxes in 2015 if you can show that for 2014 you had no liability and your 2014 tax year was an entire 12-month calendar year. In most cases, you must make estimated taxes in 2014, or again, looking forward to 2015, if you expect to owe at least $1,000 in tax for 2014 after subtracting your withholdings and credits, and you expect your withholding and credits to be less than the smaller of 90% of the tax shown on your 2014 return or 100% of the tax shown on your 2013 return. So if we're preparing a 2014 return, we're concerned about estimated taxes going two directions. Did I need to pay estimated taxes in 2014 for my 2014 return? And to determine that, I had to look at the 2013 situation. Is my income for 2014 $150,000 or more? Because if it is, then I go back to my 2013 liability, and I have to have paid in 110% of my 2013 liability. If I did, I can still owe when I file my 2014 return, and I won't owe an estimated tax penalty. But if my income is below $150,000, then I would look at my prior year liability and just make sure I paid in 100%. Now let's suppose that I have already prepared the 2014 return and I'm looking forward to 2015. Do I need to pay estimated tax for 2015? Well, now I'm going to look at the 2014 return and make a determination for 2015 that I need to pay in 2015 at least 100% of my 2014 tax or 110% of my 2014 tax if my income is over $150,000. So there's this rule here that we're really looking at estimated tax two ways. We're always looking at the current year when I'm preparing the current year's tax return. Do I owe an underpayment of estimated tax penalty with the return? And once I'm finished preparing the current year return, I'm looking forward to the next year and saying, do I need to pay taxes, estimated taxes in the year in the future? The answers to those questions really fall around how much tax is being withheld and how much money am I making and what are my deductions going to be. So estimated taxes can be a little bit tricky to figure out. What about withholdings? Well, if you are an employee, you may be able to avoid having to pay estimated taxes by having your employer withhold income tax from your pay. Even if you do not have your taxes withheld evenly throughout the year, you will avoid the penalty for underpayment of tax by having the minimum required amount withheld from your pay by the end of the year. And here we have an illustration where we have a large catch-up at the year end for withholdings. Sam works for ABC Company, and during the year he was short on cash. So Sam asked his employer to stop withholding taxes from his pay. Beginning in October, Sam asked his employer to withhold additional taxes from his pay. So long as Sam has enough tax withheld from his pay by the end of the year, he will not owe an underpayment penalty, even though his withholding was not equal throughout the year. In effect, Sam has received an interest-free loan. He has the use of the government's money all year and owes no additional tax because of it. Now, this could also work if you've got, say, a couple of jobs. You've got one job where you earn a lot of money and another job where you don't earn very much money, and getting enough withholding on this second job can sometimes be tricky. So it could be easier to just go over to the regular job and bump up the withholding there. Or maybe you've got a husband and wife, and the husband earns much more than the wife, and so her piddly little W-2, she just can't get enough withholding going on it using the regular rates. So a husband could have more withheld on his W-2. Iras doesn't really care where the money is withheld or what percentage is withheld at what time of the year, so long as at the end of the year, by December 31, you can show that enough tax was withheld. Now, there are some special rules for farmers and fishermen, because there usually are with farmers and fishermen something that are different. If at least 2/3 of your gross income is from farming or fishing, you may do one of the following. You do not have to pay estimated tax if you file your 2014 tax return and pay all tax due with the return by March 1 of 2015. Also, you do not have to pay estimated tax if you expect your 2014 income tax withholding to be at least 66 2/3% of the total tax to be shown on your 2014 return, or 100% of the total tax shown on your 2013 return. And if you must pay estimated tax, you are required to make only one estimated tax payment, which is your required annual payment, by January 15, 2015, using the special rules to figure the amount of the payment. Estimated taxes can be tricky on the surface because they kind of catch people off guard. The first estimated tax payment makes sense, April 15th. You got January, February, March, the first 3 months of the year, that's the first quarter, makes sense, and the payment is due 15 days after the quarter ends. It happens to be that it's the same day as the last day of tax season, so it's usually a big ouch. Not only have I just told my client that he owes $10,000 for 2013, but he also now has to make his first quarterly payment for 2014 at the same time. Or for 2014, it's April 15, 2015, we're filing and paying his 2014 bill, and now by the same date has to come up with the first quarter's taxes for 2015. So it's never a pretty situation catching up on April 15th with that first estimated tax payment. But what's even nastier, perhaps, is that the next quarter is only 2 months long, April and May essentially, and then you have a quarterly payment due June 16, 2014. And then the third payment is another 3 months out, September 15th, and then the final payment is where you get that 4-month spread. So you make your third quarterly payment for the period of June, July, and August. It's due September 15th, and then you've got September, October, November, December, with the final payment being due in January. Now, what happens if I forgot how much estimated tax I paid? And you may laugh at this. Who would forget how much estimated tax they paid? But it happens all the time. Every tax season, I'm sitting there with a client trying to figure out how much tax they paid because they're not sure. Now, if they had estimated tax vouchers that I gave them, and they did everything exactly like they should have, and on each voucher they wrote down the amount they paid and the date they paid, and then they have a check register that shows the same information, I think I'm pretty good to go. But just as often, they come in with canceled checks made out to the IRS at various dates. And the one from April 15th, well, how am I to know if that's the balance due from the year before or the estimated tax payment? Well, I could look at the year before's tax return and see if it's a match to the balance owed with the last year tax return. But even if it appears to not be the tax due with the return, it still may not be an estimated tax payment that they've made. It could be that they owed additional monies and the IRS billed them for that. Really, just by looking at a check, there's no way to know for sure that that was the estimated amount, unless it's a clear and decisive match to a pre-printed estimated tax voucher. Then you can probably go with it. But just as often as I have clients come into me that give me estimated tax amounts and dates paid that are accurate, I have them come in where they're giving me completely wrong information. And the most common problem I run across is elderly clients who get confused. They bring me all the canceled checks for the estimated taxes they paid in a calendar year. And for example, here we have Janice, age 70. During 2014, she made the following estimated tax payments. She made a payment on January 5th of 2014 for $550. She made another one on April 10th for 2014 of $550, $550 on June 15, and $550 on September 6th. She also made a payment on January 10th, 2015, but she didn't bring me that check. She only brought me the first 4. So I take the first 4 and I enter down the estimated tax payments, and I may or may not care about or notice the fact that the first payment is $50 off the others. Maybe it's not, maybe they're identical. but I entered the information that she gave me. We've got to watch out for these January payments because taxpayers are pretty good at seeing the date 2014 and sticking it in with everything that's 2014. And the problem with estimated taxes is that those January payments are retroactively applied to the earlier year. So this January 5th, 2014 payment, that would have been applied to the 2013 estimated tax. And the January 10th, 2015 estimated tax payment, that would have been applied to the 2014 estimated tax. And if I work off the numbers that Janice gives me without really analyzing and giving further inquiry, I'm going to tell the IRS she paid $50 less in estimated taxes than she did. And then what happens is Janice gets a letter from the IRS adjusting her refund and giving her $50 extra. And then Janice thinks I messed up her tax return because I obviously did something wrong, or why would the IRS correct it and give this different information? And the reverse could happen where Janice doesn't send in as much as she thinks she did, and on the tax return I say she sent in more than she did. So estimated taxes are such a problem, so commonly a problem, we've actually gotten to a point in our firm where we write down all the estimated tax payment amounts and payment dates on an information sheet and have the client sign off that those are correct. Now let's look at another example where the taxpayer provides inaccurate information. Mr. Hall made estimated payments during 2014. He wrote the date and amount of each payment on his check register, and then in April 2015, Mr. Hall asks you to prepare his returns. He tells you he made 4 payments of $400 each to the IRS. Watch out. If Mr. Hall did not provide the correct information on his payments, the amount you enter on his return is going to be wrong, and there's going to be letters from the IRS, and there's going to be confusion. And a lot of times these older clients, they're confused a lot. And they have a lot of time to worry. Since they're retired, they get one letter from the IRS, and they'll sit there and fume and fret on it for weeks. It's the only thing they have to think about, and they spend a great deal of time thinking about it. So just best to take care of them before they come in and take up your time solving a problem that doesn't need to be solved. Figuring the amount of estimated tax to pay. Calculating the correct amount can be tricky. The IRS provides an estimated tax worksheet that can be helpful. You can also calculate your estimated taxes manually as follows. And although I say the IRS has a worksheet that can be helpful, I don't like the worksheet. Never use it. If I go through the worksheet, bound to be that it's not going to give me the correct answer. It might be helpful with a person who has no federal withholding going on anywhere else and has very consistent income year to year. Then the worksheet can be helpful. But most of the time when I'm figuring estimated taxes, there's tremendous variation in my client's income, and the worksheet doesn't really account for that. And so I end up figuring the estimated taxes manually. So how do you go about figuring them manually? Well, you start by figuring your approximate income and deductions for the coming year. You then calculate your expected tax liability after projecting income and deductions for the current year. You subtract the amount of tax that you expect to have withheld from your pay by the end of the year, and if the difference between your anticipated tax liability and your anticipated withholding is less than $1,000, then you don't need to make estimated tax payments. And if it is at least $1,000, then you're going to divide the total by 4, and this becomes the amount of estimated tax you should pay each year. So if I'm going to owe $2,000 based on my calculations, I would take that $2,000, divide it by 4, and that means I need to send in $500 each quarter. So let's kind of go find a tax return where I can show you what I mean by these estimates here. I have to go back up and maybe under the net investment income tax. Where was I when I talked about that? Somewhere around page 30? Yeah. So let's take a look at this tax return that I prepared for this Jake character. And we nicely have page 2. His income is $320,000, and his tax liability for the year is $67,910. Plus, he's got this extra additional Medicare tax and net investment income tax going on down here on line 62. So his break-even point for tax is $70,332. Well, if I am doing Jake's tax return, and he sits there and says, do you think I need to pay estimated taxes for 2015? I would look at this and say, well, assuming your withholding is where it is, I would say, no, you don't need to make estimated tax payments. Do you expect your withholding to change in any significant way? But let's just suppose that Jake's withholding, instead of being $80,000, is $60,000. Well, if he'd only had $60,000 withheld, instead of having an $11,000 refund, he would have owed, close to $10,000. And he would have had to pay an estimated tax penalty. There's a line that he would have to enter that estimated tax penalty on right here, line 79. And very often when a client owes more than $1,000, your tax software is going to kick in and automatically calculate a penalty and enter it on line 79, and you may not even notice that it's there, so you're not really thinking about it. But the penalty is typically automatically calculated by your tax software unless you've made entries into the software to tell it that the penalty is not owed. So if you determine that you think your client is going to be required to make estimated tax payments, I personally think what you should do is predict into the future what you think their future year's tax return will be looking like and kind of dummy it up. If for 2015 Jake expects his wages to go up, but his withholding to remain flat, I might recompute his tax return with the higher wages to see whether the withholding he's had is adequate or whether he might need to make some adjustments. And whatever amount I figure he's going to owe based on my projections, I just divide that number by 4 and tell him that's the amount of estimated tax payments he should be making, and I fill out the vouchers accordingly. Or you can use the Iras worksheet, but as I said, I don't like it. Let's talk about how to pay estimated tax. So I've explained to you what you can do to basically project out and figure out what the estimated tax amount should be for each quarter, and then now it's time to go ahead and pay that tax. And there are 6 different ways to pay estimated tax. Firstly, you can credit an overpayment. You can see Jake there had an $11,000 refund for 2014. He could apply that refund forward to 2015, not receive it, and have it all go towards estimated tax. So that's one option available to him. The next is direct pay through the Iras website using your checking or savings account. You can also pay by check or money order with a voucher called Form 1040-ES, and here is a copy of Form 1040-ES. Iras has a separate voucher for each quarter. The due date is printed upon the voucher, and then you mail it in at each date shown on the voucher. You can also pay electronically using the Electronic Federal Tax Payment System, or Ef Tps. You can pay by electronic funds withdrawal if you are filing electronically. This would happen the same time you file your tax return electronically. So there is actually a feature that you can enter into certain e-file programs that you can tell the software, yes, pull money out of this client's account on these days to pay their estimated tax. And that would happen electronically with the return, and then on those dates the Iras would automatically do it. And finally, you can also do it by credit card by calling and using the payment systems that you see here. So what happens if you don't pay estimated tax when you're supposed to? Well, you'll end up having to pay a penalty. In general, you may owe a penalty for underpayment of estimated tax if you do not pay the smaller of 90% of the tax shown on your 2014 return, or the tax shown on your 2013 return, or 110% of the tax shown on your 2013 return, if your AGI is more than $150,000. Figuring the penalty. Calculate your penalty for underpayment of tax by completing Form 2210. If you do not complete Form 2210, the Iras will do it for you and send you a bill for the additional tax owed. You may be required to pay additional taxes and penalties if you do not pay your underpayment penalty by the due date of your return. And you may have to pay an underpayment penalty even if you owe less than $1,000 with your return, because the penalty is figured separately for each quarter and the payment due on each quarter. So it could be that you do a catch-up amount at the end of the year, and you wouldn't owe an estimated tax penalty for that final quarter where you did the catch-up, but it doesn't relieve you of the fact that you filed late or underpaid in each of the earlier quarters, and therefore you're still going to owe it for those earlier quarters. Now, there are some exceptions to the estimated tax penalty. You will not have to pay the penalty if either one or two applies. Number one, you had no tax liability for 2013, and you were a U.S. citizen or a resident for the entire year, and your 2013 tax return was or would have been, had you been required to file, for a full 12 months. And number two, the total tax shown on your 2014 return minus the amount you paid through withholding is less than $1,000. And again, we have special rules for farmers and fishermen. If you meet both of the following tests, you will not owe a penalty for underpayment of 2014 estimated tax. Under test number 1, your gross income from farming and fishing was at least 2/3 of your annual gross income from all sources for 2013 or 2014. And under test number 2, you filed Form 1040 or 1041 and paid the entire tax due by March 1st, 2015. So farmers and fishermen can actually get out of the estimated tax penalty by making no estimated tax payments at all during the year, so long as they file their tax return by March 1st and pay all of the tax owed with the return on March 1st. So they get a freebie one there. Form 2210, underpayment of estimated tax by individuals. You may request a waiver of some or all of the penalty for underpayment of estimated tax if you can show the IRS that the underpayment was due to a casualty, disaster, or other unusual circumstance, and it would be inequitable to impose the penalty on you. Or in 2013 or 14, you retired after age 62 or became disabled, and your underpayment was due to reasonable cause. To request a waiver, you need to complete Form 2210, underpayment of estimated tax by individuals, estates, and trusts. You would check Box A or Box B in Part 2. And if you checked Box A, you would complete only page 1. If you checked Box B, write the amount you want waived in parentheses on the dotted line next to line 17. Then attach pertinent documents and a written statement to your return explaining the reasons you were unable to meet the estimated tax requirements and the time period for which you are requesting a waiver. Reduced penalty if your income varied throughout the year. So I don't fill out a request for waivers terribly often, but I do complete Form 2210 to compute a reduced penalty because income varied throughout the year. And so let's look at an example of how your income could vary throughout the year. Jed received a large amount of income from a land sale in the month of September. In September, Jed made an estimated tax payment that is equal to the tax he owes from that land sale. He made no estimated tax payments prior to that date because he had only nominal income. Jed can use Form 2210 to reduce or eliminate his underpayment penalty for the year. So let's take a look at this Form 2210. It's a form that really escapes the notice of a lot of tax preparers. And what happens is your tax software will, at least our tax software, automatically computes an underpayment penalty. If you're seeing an underpayment penalty for estimated tax on the 1040, down at the bottom there, line 76, right? If you see that line with a number on it, that should be where you start asking yourself, okay, why does my client owe that penalty? Is it legitimate? Very often, I make the penalty go away simply by entering into my computer software their tax liability from the year before. If I have a client who is a returning client, my software will remember or pull forward information on their prior year tax liability. But if they're a new client, my software won't know what their prior year liability was, and it assumes that they are due to pay a penalty based only on the information entered for this year. Very often what will happen is I can go and enter the liability from the earlier year, and once I've done that, the estimated tax penalty completely disappears. So let's just think for a minute about how that could work. Let's just suppose, just get a note screen going here. My client's 2013 return showed a liability of $20,000. And this year, 2014, they owe $10,000. My software is automatically going to say, whoa, you owe a penalty. And it's probably going to calculate a penalty of a few $100s there. It's going to subtract $1,000 from $10,000 and arrive at $9,000. And then it's going to multiply that by 5%, come up with a penalty, and whack it on the line. And so I'm going to see this penalty appearing there for a few $100s. And the question is, do they owe it? Well, owing $10,000 doesn't necessarily mean they owe a penalty. I have to look back at the earlier year. And the question is, how much did they have withheld this year? Maybe they had withholding of $25,000. My software is going to automatically calculate an estimated tax penalty until I tell the software that the prior year liability was $20,000. And the reason they don't owe a penalty is because this year's withholding is at least 100% of last year's tax, And in fact, it's more than 110% of last year's tax. So regardless of where their income is, they simply don't owe an underpayment of estimated tax penalty. But again, it's just something you should be mentally aware of, that this goes on and that tax software will automatically figure a penalty and enter it on the form. And I actually learned a while ago by talking to people at Iras on the phone that once you put a number to figure the penalty for underpayment of estimated tax on the 1040, it's very difficult later on to go and get that removed. You actually have to go through some procedures with the IRS to get an underpayment penalty removed from the 1040 once you voluntarily put it on there. And so if your software is automatically calculating those penalties and putting them on there, that should be as kind of a stop the press type of thing. Review that particular number and see if you can't reduce it by doing some calculations. Now, you can also have a situation where they ultimately don't owe an underpayment of estimated tax penalty, not because they paid in 110% of the last year or 100% of the last year, but because their income was unequal throughout the year. And if the income was unequal throughout the year, you can use Form 2210 to tell the IRS that it was unequal throughout the year and that you can show that the estimated tax penalty is not due because of this unequal income throughout the year. Now, Form 2210 has a flow chart up at the front, and it says, do you have to file Form 2110? Complete lines 1 through 7 below. Is line 7 less than 1,000? And so let's look here. Enter your 2014 tax after credits, enter your refundable credits, enter your taxes, enter your withholding, and figure out if you owe. If the answer is it's not less than $1,000, complete lines 8 and 9 below. Is line 6 equal to or more than line 9? If no, you may owe a penalty. Does any box in 2 below apply to you? So we go down to box 2, and it says reasons for filing. You are requesting a waiver of your entire penalty. You must check this box and file page 1 of Form 2210, but you are not required to figure the penalty. Or box 2, you are requesting a waiver of part of your penalty. Or box 3, your income varied during the year and your penalty is reduced or eliminated when you use the annualized income installment method. Well, that's what I'm talking about. So let's go over and take a look at part 2. If you did not pay the required minimum tax, you can attach Form 22 to your 10, and you use Part 2 of the form to request a waiver of the penalty due to reasonable cause, or to show that you qualify for a reduced penalty or no penalty because your income or payments are allocable to specific dates. And then there is a short method and a long method. Use Part 3 to eliminate or reduce your penalty only if you either made no estimated tax payments during the year or you made all of your estimated tax payments in equal amounts for each of the 4 due dates. If that doesn't apply to you, then you go over to the regular method in Part 4, and you use Part 4 to eliminate or reduce your penalty if any of your estimated tax payments were made late, your income varied throughout the year, you wish to allocate tax withholdings to the date paid rather than equally throughout the year, or you are filing Form 1040-NR. And you will see that the way the form is designed is it says, enter in column A the income or the tax or the deduction amount that would have accrued until that point. And it actually continues on in the next page here where you have the annualized income and installment amounts. And in Part 4, up at the top, it says required installments. If box C in Part 2 applies to you, enter the amounts from Schedule AI, line 25. So where is AI, line 25? Well, the starting point is to fill out Schedule AI. And in AI, you look to the quarter of the year that is listed in the column. So column A says enter your adjusted gross income for the first quarter. Column B, you would enter your adjusted gross income for the first 5 months of the year. In column C, you would enter your adjusted gross income for the first 8 months of the year, and then in column D, you enter all of your income for the entire year. And in doing so, you can show the IRS how your income may have been unequal throughout the year. You go through and follow these same procedures for claiming any withholdings or any estimated tax payments or any self-employment tax due. And once you've gone through, you total up all of these amounts to see whether or not it was not necessary to pay income tax or estimated tax in greater amount in the year, and so that it was totally okay to pay one payment later in the year. And so this form walks you through all of that to ultimately calculate the estimated tax penalty you owe. I haven't got an illustration of the form filled out. I'll try and do that for you in a later year. I just kind of run out of time preparing for these classes with everything I want to do. The next topic we're going to look at is power of attorney and tax information authorization. You may authorize a tax practitioner or another individual to receive information from the IRS by signing Form 8821 Tax Information Authorization. You may also authorize certain individuals to represent you before the IRS by signing Form 2848 Power of Attorney. Form 2848 Power of Attorney is allowing the practitioner or another individual to actually represent a tax client before the IRS. And the individual that you authorize must be an individual who is eligible to practice before the IRS. The representatives you name must sign and date the declaration and enter the designation, for example, items A through R, under which he or she is authorized to practice before the IRS. So we have designations for the types of individuals who would most commonly complete a power of attorney, and they include attorneys who get a code A, certified public accountants who get a code B, and enrolled agents who get a code C. There are other types of individuals who can also have unlimited representation rights, and they include officers of companies, full-time employees of companies, a family member of an individual, and enrolled actuary. But then we also have other categories of individuals who would have more limited representation rights, and they are shown here with unenrolled tax return preparer and registered tax preparer. And then we also have a couple of different authorizations that can be given to students. And then we also have something called an enrolled retirement plan agent. For students in LITCs and STCP, you must receive permission to practice before the IRS by virtue of your status as a law, business, or accounting student working in a low-income taxpayer clinic or the Student Tax Clinic program. And if that's you, you can get the ability to represent someone before the IRS, but it's usually done on a volunteer basis, not for money, right? Signatures. Both you and your representative must sign and date the power of attorney, and if a joint return has been filed, your spouse must execute his or her own power of attorney on a separate Form 2848 to designate a representative. So this gets a little bit getting used to, because when you fill out the 2848 for a married couple, and you may need to have both of them sign a 2848 because they filed a joint return, it can be difficult to get the information you need when only one of the spouses signs the 2848. Not impossible, but it can be difficult. Limited representation for registered tax return preparers and unenrolled return preparers. Registered tax return preparers are those group of people that actually took the RTRP exam while it was being offered. And that category of person, although they're still not really being recognized by title, the IRS is doing away with the registered tax return preparer designation, they're still being recognized in the accomplishment that they had in passing the test. But they are still deemed to be unenrolled tax preparers, and they may only represent tax preparers before revenue agents, customer service representatives, or similar officers and employees of the IRS, including the Taxpayer Advocate Service, during an examination of the taxable period covered by the tax return that they themselves prepared and signed. Registered tax preparers and unenrolled return preparers cannot represent taxpayers, regardless of the circumstances requiring representation, before appeals officers, revenue agents, consul or similar officers, or employees of the IRS or the Treasury. Registered tax return preparers and unenrolled preparers cannot execute closing agreements, extend the statutory period for tax assessments or collection of tax, execute waivers, execute claims for refunds, or sign any document on behalf of a taxpayer. If a registered tax return preparer or an unenrolled tax return preparer does not meet the requirements for limited representation, you may authorize the unenrolled return preparer to inspect and or receive your taxpayer information by filing Form 8821. Completing Form 8821 will not authorize the unenrolled person to represent you. Now, I should point out that there is an important rule that begins beginning 2016. It's not in effect now. It will take effect January 1st, 2016. Unenrolled tax preparers may represent tax clients before the IRS with respect to examination of a return that they prepared only if they have successfully completed the Annual Filing Season Program, or AFSP. The AFSP is intended to recognize and encourage unenrolled tax return preparers who voluntarily increase their knowledge and improve their filing season competency through continuing education. If you're not an enrolled agent, you're going to need to be completing this annual filing season program. unless you're a CPA or an attorney or you're an enrolled actuary. If you are an individual who wants to be able to represent your clients before the IRS with respect to a tax return you prepared, and you are not an enrolled agent, you are not an attorney, you are not a CPA, this is the procedure that will apply to you beginning January 1, 2016. Firstly, you must complete successfully the annual filing season program and obtain a certificate from the IRS. Certain non-exempt preparers do not have to take an annual refresher course, but everyone else who is not an exempt preparer must take a 6-hour annual federal tax refresher course called the AFTAR that covers filing season issues and tax law updates, as well as a knowledge-based comprehension test administered at the end of the course by the CE provider. And I believe that test has to have 100 questions in it. So there's 6 hours of education followed by this 100-question test. In addition, the preparer must obtain 10 hours of education in other federal tax law topics and 2 hours of education in ethics. So the total is 18 hours, 6 of which is the AFTAR course, 10 of which is general federal tax law topics, and 2 of which is ethics. They must also have a valid Preparer Tax Identification Number, or PTIN, and they must consent to adhere to specific practice obligations outlined in Subpart B of Treasury Circular 230. Now, for the 2015 filing season, the annual filing season program was introduced. And there are people who went through and obtained an annual filing season program certificate for the 2015 season. You don't need to have that certificate to have limited representation rights before the IRS for calendar year 2015. That begins in 2016. But in 2015, anyone who wants to have those representation rights beginning 2016 must complete the annual federal program in 2015. And so for 2015, unenrolled tax preparers who hold a valid RTRP credential, that means they passed the IRS test, or they are another form of recognized credentialed tax preparers, such as Oregon LTPs and LTCs or California registered tax return preparers, are exempt from the 6-hour AFTAR course you see up here. Instead, they will take 3 hours of federal tax law update, as well as 3 hours of federal tax law topics for 2015, which they took it in 2014. For 2015, it needs to be 10 hours, and 2 hours of ethics. So during 2015, which we are in now, tax preparers who are deemed to be exempt because they either passed the RTRP exam, or they are a CTEC registered tax preparer in California, or they are an Oregon licensed tax preparer. If they're one of those 3 groups, they're exempt from the annual federal tax refresher course that is 6 hours long. And instead, they're going to take a 3-hour federal tax law update each year. For 2015, they have to complete 10 hours of federal tax law topics plus 2 hours of ethics. And it was only for 2015 that this requirement of 3 hours was in place. For anyone who's taking my course today, you need to have 10 hours by the end of 2015 if you want to get your 2016 certificates. And for more information about this topic, visit the Iras website at the URL you've seen there. And just before we head into break, I want to show you the Form 8821 Tax Information Authorization. So Form 8821 Tax Information Authorization, this form authorizes any individual, corporation, firm, organization, or partnership that you designate to inspect and or receive your confidential information from any office of the IRS for the type of tax and years or periods that you list on the form. Now, if you are an individual who is a tax preparer and you are not an enrolled agent, a CPA, or an attorney, and you want to get information about your tax client, you're not going to be able to use Form 2848 to get that information unless you prepared the tax return relating to that information, and by 2016 you have passed the certification program. But for 2015 and 2016, it is still going to be possible to get information about your client's return, but if you can't use a power of attorney, then Form 8821 is the form that you use. And you simply fill it out, have the client sign it, and then you are able to get the IRS to provide you with information about their confidential account that you cannot disclose information or tell the IRS information to try and help your client because the IRS just won't listen to you. You have to have a power of attorney for that. Signature, you must sign and date the authorization. If a joint return has been filed, your spouse must execute his or her own authorization on the separate Form 8821 to designate an appointee. You may file your own tax information authorization without using Form 8821, but it has to contain all of the same information as the 8821. So let's come up on the last break of the day, and when we come back from this break, we're going to go into the next topic, which is amended returns. And while we're on break, I'll put up the second password of the day, and I will also put up a couple of C questions to keep you busy. Password number 2 is thrush, T-H-R-U-S-H, thrush. All right, welcome back from break, everyone. And let's just take a look at a couple of C questions I put up on the board to keep you entertained during your break. The first question says, James Lee had a total tax liability in 2013 of $20,000. Then in 2014, the taxpayer has a tax liability of $25,000. The taxpayer's withholding has increased to $23,500. He will file his return for 2014 on April 10, 2015. To avoid the underpayment of estimated tax penalty, the filer must what? And the options are pay the additional tax of $1,500 due by April 15th, or pay the additional $1,500 by January 15, 2015, file an annualized estimated tax computation, that would be using Form 2210, or do nothing at all as he has satisfied the minimum tax payment requirements. And the correct answer is actually D. Let's take a look at why it's the correct answer. And this is an actual IRS question. It's a pretty scopish one in terms of what it's expecting you to understand and how you're supposed to be interpreting the wording there. So this is a specific question about whether or not he owes a late payment penalty, but whether he owes an underpayment of estimated tax penalty. And you owe an underpayment of estimated tax penalty if you have underpaid your estimated tax throughout the year. And to figure if he's underpaid his estimated tax, you have to look at the year and determine, was his withholding at least 100% of the prior year liability or 110% of the prior year liability if his income was over $150,000. Well, we actually don't tell you what his income is, but we do show you what his withholding is, and we show you what his prior year liability was. Well, his prior year liability was $20,000, and this year he has a liability of $25,000, but the withholding for this year is at least 100% of last year, and it's also at least 110% of last year. So even though he still owes, he does not owe a penalty for underpayment of estimated tax. So he actually owes $1,500, and if he files his return and pays the minimum tax payment on April 15th, which is he pays his balance due on April 10 or April 15th, he's not going to owe an underpayment of estimated tax penalty, and there's nothing he needs to do with respect to estimated tax. He certainly doesn't need to pay an estimated tax penalty or payment by April 15th, and he doesn't need to make an estimated tax payment by January 15th either. He simply needs to file a tax return on time and pay the tax he owes with it, which is $1,500. And so Iras is the one that said that D is the correct answer. All right, so let's look at the next question in line, which is another estimated tax question. Iras likes to ask these estimated tax questions. They also like to ask questions about penalties. In this question, Violet made no estimated tax payments for 2014 because she thought she had enough tax withheld from her wages. In January of 2015, she realized that her withholding was $2,000 less than the amount needed to avoid a penalty for underpayment of estimated tax. So she made an estimated tax payment of $2,500 on January 10 of 2015. Violet then filed her 2014 tax return on March 5, 2015, showing a refund due to her of $100. Which of the following statements is not true? So by saying one of these statements is not true, it means that three of the statements are true. And the correct answer is actually B. So the only incorrect statement here is B. Violet will not owe a penalty for any quarter because her total payments exceed her liability. That is the false statement. Her payments do exceed her liability, but the payment was made late. And because it was made late, she's going to owe penalties for those earlier quarters. So the other statements in here are actually true. Violet will not owe a penalty for the quarter ending December 31st because she made sufficient payment before January 15th. That's true, because December 31st is in the final quarter, and the January 15th payment would be for the final quarter, and it was timely for the final quarter. Option number C is also true. Violet could owe a penalty for one or all of the first 3 quarters. That's right. She could owe a penalty for the first quarter and that she had to make a payment by April 15th. She had a payment that was due by June 15th, and she apparently didn't pay all that she was supposed to then. And then again, September 15th. The payment she made in January is good only for the final quarter. It is late for all of the other quarters, and so she could still be subjected to a penalty for them. And then finally, if Violet owes a penalty for any quarter, the underpayment will be computed from the date that the amount was due to the date that the payment was made. And so she did make a payment in January, and therefore any estimated tax penalty she has is going to be computed from the due date of that quarter. So if there's a penalty being calculated for the first quarter, it's going to be based on the period of time from April 15th until January 10th, and the amount of penalty will be based on that. And then if her payment was late for the second quarter, it would start June 15th and look until the date she paid it. So ultimately, the only statement in here that is a false statement is B, which makes B the correct answer. All right, so the next topic of the day is amended returns. And there are a couple of things that I don't like to see first-year tax preparers doing, and there's a couple of things I don't like to see even experienced tax preparers doing unless they've had a good amount of training on preparation of certain forms. And one of these forms I'm referring to is, of course, amended returns. But also, I don't like to stick unexperienced preparers in front of multi-state tax returns. Understanding how to break up income between one state and another on state tax returns can be intimidating if you're not experienced with reading forms, understanding how the different states are going to interpret income and deductions. Multi-state tax returns can be a challenge. But right up there with multi-state returns, I also put amended returns. Even if the only income you had for the year was a W-2 and you had 2 dependents, an amended return can still be a challenge. So this part of the class is really designed to help walk you through all of the steps necessary to prepare and file an accurate amended return, and also to look at some of the things that I see go on with tax preparers that can happen because of how software works and so forth. So if you made an error on your tax return, you can file Form 1040X to correct the error and receive a refund or pay any additional tax that you owe. Just a caution, an amended Form 1040 return cannot be filed electronically at this time. Iras is threatening to make it a possibility in the future, but currently you have to file amended returns paper. However, the Iras does accept current year 1065 and 1120 series amended returns electronically. So if you're filing a partnership or a corporate return, those can be amended electronically, but not individual returns. Amending your state return. If you amended a federal return, you may also be required to file an amended return with your state. In certain states, it is possible to electronically file an amended return. So don't assume that because you can't e-file an amended federal return that you cannot also not e-file a state return. Lots of states allow e-file on amended returns. Now, I should tell you that when you file an amended return with the IRS, and you tell the IRS that you owe more money, and the IRS looks at that return, they do send a notification to the state of an adjustment in income. And if you fail to file an amended return with the state has a number of years that it can come after you for failing to file and pay additional tax with the state. So just be aware that there is communication that goes on between the IRS. It does disclose information to the states, and therefore if you are preparing an amended federal return and there is a change in tax at the federal level, you'd best be on board with taking a look at the state return and handling it while you're at it. So when do you file Form 1040X? Well, you file Form 1040X only after you have filed your original return. And generally, you file Form 1040X for a refund or a credit within 3 years, including extensions, after the date you filed your original return, or within 2 years after the date you paid tax, whichever is later. So it's possible that you could have filed a regular return but filed it late. I'm just going to pull up another box here. Kind of a new scenario here. Let's suppose you filed your 2009 return in 2013. All right? Well, the original due date of that 2009 return was April 15, unless that was a holiday it could have been. April 15-ish, I'll say, of 2010. You know, if we've got the 15th of April falling on a weekend or following or Emancipation Day falling on the day after the weekend, it can push out to April 16th or 17th, and it wouldn't surprise me at all if 2009 was one of those years. But at any rate, we're just going to go hypothetically that April 15th was the filing deadline for 2009 returns, and that you didn't file on that date. Instead, you waited till sometime in 2013. And now it's 2015. Here we are in 2015. In 2015, can I file an amended 2009 return? Is it possible? Well, according to what we're reading here, it looks like it is. You can file an amended return within 3 years, including extensions after the date you filed your original return, or 2 years after the date you paid tax, whichever is later. So this late filing of the amended return, there's going to be some parameters in there. It's possible you can file an amended return, but even if you file the amended return, you may not receive your refund unless the return is filed within 2 years of the date you actually filed and paid tax. And so it would depend on the date that it was filed in 2013 as to whether or not we're going to be able to file for a claim of refund with this late filed amended return. Now, a return that is filed early is generally considered to be filed on the due date, April 15th. However, if you had an extension to file, for example, until October 15th, but you filed earlier than October 15th, your return is considered to be filed on this earlier date. For Federal Form 1040-X, you should file a 1040-X to correct your return if you find that you did not report some of your income, or that you claimed deductions or credits that you should not have claimed, or you did not claim deductions or credits that you should have claimed. You should also file it to claim a different filing status or to add or remove dependents. But generally, once you have filed a joint return, you are not going to be allowed to return later and file married filing separate. So you can file an amended return to go from separate to joint, but typically the IRS will not allow you to go from joint to separate. And the only exception to that is if you file an amended return before the original due date of the original return, or if you are the administrator of an estate. And it could be that you've got a surviving spouse who at the end of the year filed a joint return with the decedent, and as administrator of the estate, you're coming along and saying, no, I want this final filing to be a separate filing. And if that's the case, you have 1 year from the due date of the return to change from married filing joint to married filing separate. But if those two situations don't apply, then you can typically not file married filing separate on an amended return after the original due date of the return. And here we have Form 1040-X, and you can see that Form 1040-X is divided into 3 columns, and we have a column to represent amounts that were reported on the original return, a column to report amounts on the corrected return, and then in column B you enter the difference between amounts shown on the 2 returns. Page 2 is devoted to providing information about changes in the number of exemptions shown on the original and amended return. And then in Part 3, you enter a description or an explanation of the reason why you are filing an amended return, including the changes that have been made on that amended return. And then, of course, there's a place to sign. So moving on, the IRS does want you to know that there are special situations that are commonly associated with amended returns. I can't say I actually find these special situations pop up for me very often, but the IRS says that they are key reasons why amended returns get filed. Many amended returns deal with situations that have special qualifications or special rules that must be followed, and IRS wants you to refer to these special rules in the instructions for Form 1040-X, but they are referring to things such as the additional Medicare tax, certain airline payments rolled over to an IRA, a carryback claim for a net operating loss, or a carryback claim for other credits and other losses, for a deceased taxpayer, for household employment taxes because of an injured spouse claim, qualified reservist distributions, reimbursement received for hurricane-related casualty loss, relief for homeowners with corrosive drywall, same-sex marriage, and tax shelters. Preparing your amended return. Follow these procedures when preparing your amended return, and you begin by preparing a new 1040 and attaching all the correct schedules and forms to that new 1040. You then compare the numbers shown on the original 1040 with the numbers on the corrected 1040. And then you complete Form 1040X using information from both the original and the corrected forms. Now, one of the things I did want to spend a little bit of time talking about is how tax software thinks, because tax software doesn't necessarily work the way you want it to. And this is where inexperienced preparers can run into trouble. For a number of years, I used Lacert software. And when I wanted to prepare an amended return, I simply went into the original program or the original return that I wanted to create, and I said, hey, Lacert, I'm preparing an amended return. And I would start that new return with a new receipt number, and I could have two files for the same client operating inside Lacert simultaneously. A number of years later, I switched over to Drake, and Drake does not allow you to create a file in any method whatsoever other than under the Social Security number of the client. And so that means if you already have the client in there as an original return, if you go in and do any changes, you've altered the original return and you no longer have a record of what that original return looked like. And there is an autofill function in Drake. I know that Lacert had this as well, where you just click, yes, I want you to autofill a 1040X for me, and it will autofill that form out. But you have to be thinking about what that software is doing and the purpose of the autofill. The purpose of the autofill feature is to fill out column A. Column A is this column right here, amounts that were reported originally on the original return. If you click autofill the 1040X after you've made changes, it's going to put the wrong amounts in column A. So remember, if you were using an autofill feature in your tax software, that you should click the autofill and have the software autofill column A for you before you make any changes. Once you've made changes, the autofill is invalid, and then you're going to have to manually fill in these numbers to get them accurate. So let's take a look in a little bit more detail on preparing the amended return. And we have an illustration here for characters named Frazier and Lilith Crane. They moved from Pensacola, Florida to Albuquerque, New Mexico on October 10, 2014. They filed their original 2014 return using TurboTax, but they did not claim moving or educational expenses because they did not believe that they were eligible. The Cranes have now been advised that they were eligible to deduct their moving expenses because Frazier worked 39 weeks in the 12-month period that began on their arrival at their new home, and they had the following moving expenses. They paid $1,200 one way for U-Haul. They paid gas of $1,400 for that U-Haul. Lilith drove the family car. Labor to pack household goods and load them into the U-Haul was $300, and labor to unpack the household goods and bring them into their new home was another $200. Lodging for the last night in Pensacola was $100, and lodging along the way to Albuquerque was $200, and they also paid $100 for meals along the way. Well, just looking at all of this information, I can tell you right now the meals are not going to be allowable, but all of the other expenses shown here are going to be allowable. And so after I go into my software and click Autofill to begin the 1040X, then I'm going to start making changes to the return. And obviously, there's a couple of changes I'm going to be making to the return. One is to complete a Form 3903 for the move, and the other is going to be to complete Form 8863 because Lilith had some education expenses and qualifies for the American Opportunity Credit. Lilith finished her BA studies in May of 2014, and her 1098T is attached. She has not claimed educational expenses in any of her prior years. This will be the first bachelor's degree she has, and she has no felony drug convictions. Well, the first thing that starts going through my mind is not only is she eligible to amend the 2014 return to get a refund of the American Opportunity Credit, but we can probably also go back in time and amend the earlier years and get refunds for those as well. Did a map quest here to see the distance that she traveled because we're going to use that to figure her mileage amount. And now it's time to line up her finished returns. And I've got the amended returns shown here, but let's just first go and look at the 8863 and the 3903. And on the 8863, we're figuring her American Opportunity Credit. Ultimately, she has a $1,000 refundable credit and a $1,500 non-refundable credit. And then we move down to Form 3903, and on the form we've determined that her allowable moving expenses are $3,716. So now that we've figured her 3903 and her Form 8863, we're going to take a look at her original and her amended returns. And on her original return, the wage income is the same. So we have adjusted gross income for the Cranes on the amended return of line 37 of $76,500. The total income on the amended return is the same, but now we've thrown in the adjustment for moving expenses. So the adjusted gross income on the amended return is lower, $72,784. So that means when we go over to Form 1040X, in column A, from line 37, in column A, we're going to enter income from the original return of $76,500, and from the amended return, we're going to enter $72,784. Moving on to page 2 of the original return, things get a little bit busier in how we transfer information over to the 1040X. We begin by looking at lines 40 on both returns and line 42 on both returns. And we're going to go over to the 1040X, and for the original return, we're going to enter $12,400 on line 2 in column A, and we're going to enter the same amount in column C. And then we're going to do this for the exemptions. In column A, we're going to enter $7,900 in column A, and we're also going to enter $7,900 in column C, because on both returns the numbers are the same. We then look to some special lines on the forms. One line to be concerned with is that on the original return, there was no tax credits claimed. But on the amended return, we have a $1,500 tax credit. So on the original return, we're going to enter 0 in line 7, column A, and we're going to enter $1,500 in column C of that same line. Then we move on to looking at the amount of tax that was overpaid on line 75, and this is the refund from the original return. So on their original return, the Cranes had a $999 refund. That's going to carry over to the Form 1040X and get entered on line 17. Also, the Cranes have withholding and tax credits, and on the original return and the amended return, the withholding is the same. So column A and column C, we're going to enter the withholding on line 11, and there would be no difference in column B. Column B will be 0. But when we move on to refundable credits, we're going to enter 0 on line 14 of column A, and we're going to enter $1,000 in column C of the 1040X. And then finally, the total payments that are going to be entered on line 74 of the amended return are $9,525. So let's take a look at this 1040X. Up at the top, we check the box for calendar year 2014. We enter the name of the filers, and we enter the filing status that's being chosen. And then we also, there's a checkbox on here, did you have full year health insurance coverage? We're, of course, saying yes. And then in column A, we enter the adjusted gross income from the original return in column A, and we enter the adjusted gross income from the amended return in column C. And then to the extent that there's a difference, we enter the difference in column B. And in this case, the income dropped, and so column B is a negative $3,716, which is the amount of the moving expense deduction. There is no change in the amount of exemptions, but there is a change in the amount of taxable income, and that is equal to, again, the moving expense deduction. Then we go and look at the tax tables and figure out the tax. Well, the taxable income has dropped, and therefore the tax has dropped by $562. Then we enter the non-refundable education credit. And so the difference between the non-refundable education credit and the lowering of tax means that the net tax for these filers has dropped by $2,062. And so the net tax liability on line 8 is $5,464. On the original return, it was $7,526. The next step is to enter in the amount of refundable credit, and on the original return it was 0. On the amended return it's $1,000, so the difference is $1,000, and we check box for 8863. The next step is to add up the withholdings and credits. So we're going to take the withholding from the original return and add in the refundable credit. That gives us $9,525. And then we put in the amount of refund already received from the original return. That was $999. We subtract that out, and we get $8,526. And the next step is to subtract the tax shown on the amended return from the amount shown on line 19. And when we do that, the difference is $3,062. Now, another place that you can see $3,062 is to take the difference in tax and negative $2,062, and to that add the refundable credit of $1,000, and you end up right back at that same number. On page 2 of the Form 1040X, we enter a description of the reason for the changes. There was no change to the exemption deductions, and so because there were no changes to any of the exemptions, Part 1 up here under exemptions is blank. And then we go down to Part 3 and describe all of the reasons for the changes. And then, of course, we have the 8863 and the 3903. And then let's talk about assembling that amended return. When you assemble an amended return, you're going to take that completed 1040X and you're going to put it on top of the 1040. In addition to mailing the 1040, you are going to attach any other forms or schedules that have been altered or added. But you don't need to send copies of unchanged forms. So, for example, if there was a rental schedule that had been attached to the original return and there are no changes to the rental schedule, you wouldn't need to mail it a second time. There'd be no harm in doing so, but you're not required to. So when you file your amended return, you send the 1040X, you send the amended 1040, and underneath that you attach any other forms or schedules to which there are changes or which are new entirely. And then you sign at the bottom of page 2 of the 1040X. You don't sign the amended 1040. Now, for a refund, if you are requesting a refund with Form 1040X, expect it to take a minimum of 3 months to be issued. Now, I can tell you that because of the budget cuts to IRS, nothing is happening timely with anything to do with paper submissions of tax returns, and don't be surprised if it takes a lot longer than 3 months. For a balance due, if you owe additional tax with your return, you should pay the balance due with the amended return. You can also calculate and pay any penalties or interest due with the balance due. I personally can't be bothered because that requires figuring it all out, which is a bunch of extra work that I don't want to charge my client for. I simply tell them that whatever I'm telling you you owe on this return, that's not all of it. There's going to be additional amounts owed, and when the IRS calculates what the late payment penalties are or what the interest is that you owe, they're going to send you a letter and say, yeah, we got the amended return. Yes, we got the check with the amended return, but here's the additional amount that you owe, and here's how we calculate it, so that when my client gets that letter, they can understand why they've received it and pay that tax. But if you give your client an amended return that shows that they owe, and you do not tell them that they're going to owe additional amounts on top of that, when they get that letter from the IRS saying that they owe even more, they can be rather upset. So it's good to cover that base with your clients. All right, the next topic of the day is tax on investment income of certain minor children. To prevent wealthy individuals from avoiding tax by turning their investment income over to their minor children, the government created the Kiddie tax. And the Kiddie tax is assessed against investment income that exceeds $2,000 for a minor child who was under the age of 18 on the last day of the year, certain children who were age 18 on the last day of the year, and certain full-time students over age 18 and under age 24 at the end of the year. Now, there are two different ways that the Kiddie tax can be assessed. Firstly, it can be assessed by attaching Form 8814 to the parent's tax return, or it can be assessed by attaching Form 8615 to the tax return of the child. So we're going to take each of these forms in turn, beginning with Form 8814, which is the parent's election to report the child's interest and dividend income. If your child's interest and dividend income, including capital gain distributions, totals less than $10,000, you, if you are the parent, may be able to choose to include your child's investment income on your return. If you choose to report your child's investment income on your return, you do so by attaching Form 8814. If you choose to include your child's income on your return, your child's income is going to be taxed at your higher rate. To be able to make the election, though, your child's income must come only from very specific types of income, including interest or dividend income, including any capital gain distribution shown on a 1099 DIV, or from Alaska Permanent Dividend Funds. But you cannot include on your own return income of your child that comes from the sale of stock or other property, which must be reported on Schedule D, or because the child had a job and received a W-2, or because the child had any other form of income that was not interest or dividends. So how do you make the election? Well, to make the election, you must be the parent of the child, and if you and the other parent of the child do not file a joint return, you need to be able to show that you are the parent whose return should be used to report the income of the child. And I have a chart to show you that a little bit later in the manual. We'll cover that in a few minutes. You can make the election to report your child's income on your return if all of the following conditions are met. Your child was under age 19 or was under age 24 and a full-time student on January 1, 2015. Your child is required to file a return if you do not make this election. Your child had income only from interest or dividends as described above. The gross income was less than $10,000. No estimated tax was paid under your child's Social Security number. No federal income tax was withheld under your child's Social Security number through backup withholding on a 1099 DIV or a 1099 INT. And you are the parent whose return must be used when applying the special rules for children, and the child does not file a joint return. So why would a person file Form 8814? There's a lot of rules that you have to filter through. It doesn't seem to be a very broad form. Well, there are some advantages and disadvantages to filing the form, and you'd better be on top of them. Recently, we had a client come to us who had been to another tax practitioner in an earlier year. And in that earlier year, that tax practitioner had included the child's income from interest and dividends on the parent's return by attaching Form 8814. And the child actually had a significant amount of investment income. I don't know how they had acquired the income, possibly through an inheritance or something, but it was a substantial amount of income. $3,000, $4,000, somewhere in that neighborhood. And the thing was that the amount of income of the child was substantial enough that when that income was included on the parent's return, it caused the parent's investment income to go above the threshold amount for receiving the earned income credit. And so the parents, in and of their own right, based on their income and their own investment income, easily qualified for the earned income credit. But once this child's income was added to their return, they didn't get the earned income credit at all. And the preparer who worked on the return, it didn't cross his or her mind that by putting the child's investment income on the parent's return, that the parents were being jilted out of thousands of dollars of earned income credit. So do watch out for Form 8814, especially when you're looking at lower income filers, to make sure they're not being kicked out of any other tax credits. But including the child's income on the parent's return can have negative effects on the parents in numerous ways, so do carefully analyze whether you're going to use it. So are there any advantages to using the form after that scary story? Well, the answer is yes, because if this is the only income the child has, then the child would not need to file their own tax return. And the parent's investment income is increased, which may allow the parents to claim a larger investment interest deduction if they have the ability to do so. Also, the ceiling for charitable contributions is increased, and really the first $2,000 of the child's income is not included in the parent's taxable income, and this can reduce the state tax liability in states that base their tax on the federal taxable income. But there are disadvantages to using the form for sure. You will increase your AGI with the following possible negative effects. Deductions that are subject to AGI phase-out may be reduced. EIC, child and dependent care, and child tax credits may be reduced. State taxes may be affected for states that base their tax on federal AGI. And the child's income may be taxed at a higher rate than it would be on their own return. And your child may miss out on the following deductions: a higher standard deduction for the blind, a penalty on an early withdrawal, and itemized deductions such as their investment expense or charitable contributions would obviously not be claimable. So let's look at an illustration here of how Form 8814 works. J.R. Ewing is reporting $50,000 of wage income. He is also electing to report interest income of $4,500 and ordinary dividend income of $1,000 earned by his dependent son, John. The 1040 taxable amount shown on line 43 of J.R.'s 1040 return is shown here. And so J.R. has taxable income of $39,400. We're going to go on tax tables for his income and figure that his tax is $5,713. And we're then going to take that tax and put it, just kind of mark it in our brain because we're going to have to use it. We then go over and fill out the 8814 for John Ewing. And John Ewing had some investment income. And so we report that investment income as follows. We have $4,500 of interest income, and we have $1,000 of dividend income for the child. Now, the child has a $2,000 subtraction that they get off their income. So when we total up John's income, we have $5,500. We subtract out that $2,000 number. It's a flat number. And we're left with the difference, which is $3,500. This $3,500 is going to carry over to JR's return, and it's going to be entered on the other income line, line 21. And then we're looking at what's left to do with the remaining $2,000. Well, of the $2,000, $1,000 is set aside as that child's standard deduction and no tax is assessed on that first $1,000. The second $1,000 is a tax of $100, or the way the tax tables work, it might come out at $101. So essentially what JR is going to do to figure the tax he owes is he's going to include $3,500 of his son John's income on his return and add it to his own income. And then he's going to go look up the tax on his income plus John's income, and that's $5,713. And then he's going to fill out the Form 8814 and figure he's going to add $100 to his tax. So how does that spell out on the tax return itself? Well, on the tax return itself, we show that taxable income of $39,400. We look up the tax that he owes on his own income of $5,713, and then to that tax from the tax tables of $5,713, we add in the $100 of tax shown on Form 8814, and we check the box on line 44 and add $100 to the $5,713, and that becomes $5,813, and that becomes JR's net tax for the year. So let's compare that scenario to the scenario of a child having to file their own return and being subjected to the Kiddie tax on their own return. If a child's interest, dividend, and other investment income totals more than $2,000, part of that income may be taxed at the parent's tax rate instead of the child's tax rate. If the parent does not or cannot choose to include the child's income on the parent's return, you use Form 8615 to figure the child's tax and then attach that form to the child's return. So who must file Form 8615? Well, 8615 is not filed by all children. It's only filed by children who have investment income that's subjected to the Kiddie tax. So if your child has income from a job, that would not trigger the need to file Form 8615 because the child's wages are actually taxed at the child's rate, not the parent's rate. Form 8615 is really intended to prevent rich parents from funneling their investment income over to their children and trying to take advantage of the lower tax rate of the child. So when a child has a significant amount of investment income, that's when it kicks up and gets taxed at the parent's higher rate. So Form 8615 must be filed for a child if all of the following statements is true. The child's investment income was more than $2,000, and the child is required to file a return for 2014, and the child was either under age 18 at the end of the year, was age 18 at the end of the year and did not have earned income that was more than half of his or her own support, or was a full-time student over age 18 and under age 24 at the end of the year and did not have earned income that was more than half of his or her own support, and at least one of the child's parents was alive at the end of the year and the child did not file a joint return for the year. So figuring the Kiddie tax, well, these are the steps you follow. Got that itchy nose problem again. I only get it when I teach tax school. It's crazy. Refer to the chart on page 95 of this manual. Which parent's tax return to use when calculating the tax on investment income of children? Then figure the child's tax on Form 8615 using these steps. In Part 1, figure the child's net investment income, including income from interest and dividends, and capital gains, Social Security, pension payments, certain kinds of trust income, and rental income. Then in Part 2, figure a tentative tax on the net investment income based on the parent's higher rate. And then finally in Part 3, figure the child's tax. So here is the form where all of those computations go on. You can see it is a multi-part, multi-step form. And we're going to show you an illustration of how to complete it. In this illustration, we have, just get the magic percentage to get the screen to fit. There we go. A character named Richie Rich, who is 10 years old. And he is the dependent child of Richard and Regina Rich. During the year, Richie received $20,000 of ordinary dividend income, and a copy of his parents' Form 1040 is shown below. Prepare Richie's tax return using information from his parents' return. So in order to figure the Kiddie tax, you really have to have a copy of the parents' return, and the parents' return has to be prepared first. The first thing we observe is Richard and Regina Rich are fairly well off. They had $120,000 of wage income, $300,000 of ordinary dividends, so their income for the year is $420,000, and that puts them in the 35% tax bracket. We're just giving them a standard deduction and a partial exemption deduction. Their income is so high they're phasing out on exemptions. But they end up with taxable income of $406,000. $652. And when you follow that down to the tax rate computation table that you see here, we enter the amount from line 43 of their federal return. We multiply that by 35%. We get $142,328. We then subtract out $32,197 to arrive at tax of $110,131. And this is the point where we now can move over and prepare Form 8615 for Richie. But of course, for Richie, we first have to prepare his personal return. And we figure on line 37 that his adjusted gross income is $20,000. We go over to line 40 of the return and enter his standard deduction, which will be $1,000. Because he is a dependent of his parents, he does not get an exemption deduction. And his taxable income on line 43 is then going to be $19,000. Line 44 is where we enter the tax, and to figure the amount to enter on line 44, we're going to have to do an 8615. So we go over to 8615 and fill it out. And on line 1, we enter Richie's income. On line 2, we enter a deduction of $2,000. It's a flat amount. That $2,000 represents $1,000, which is his standard deduction, plus an additional $1,000 that's going to get taxed at a maximum rate of 10%, or another $100. Then on line 3, we have the total amount of income that he has that's going to be taxed at the parent's higher rate. And so $18,000 is the amount that will be taxed at the parent's higher rate. And the next step is to then take the parent's income and add $18,000 to the parent's income. So remember back up top when we were looking at the parent's return, we had taxable income here on line 43 of $406,652. That number gets carried down and entered on line 6 of the 8615. And then we add in Richie's income of $18,000 to get $424,652. Now it's time to figure the tax on $42,652, and we're going to go over to that same tax computation worksheet that we used for his parents, but this time we're going to start with the higher number. And we figure 35% of that, we get $148,000. We subtract out $32,197. We get $116,431, and we take that and we enter it on line 9. And then the next step is to subtract out the amount of tax paid on the parent's return, $110,131. And now the difference between those two amounts is going to be the tax that Richie owes on this $18,000 figure right here. So Richie owes $6,300 on this $18,000 of income. He's not done. He still has to add in 10% of $1,000. In this case, it worked out to be $101. And we're going to add that $101 to $6,300, and that gives us $6,401. That $6,401 then carries up and is entered on line 44, and that is how he computes his tax. Now, if you are subjected to the Kiddie tax, you do have to pay attention to which parent's tax return is being used to figure the Kiddie tax. In this case, we had a married filing joint return, and it was pretty easy to figure out whose form we should look at. But in certain situations, you may have parents who are divorced or separated, and which parent's return are you supposed to use? So if the filing status of the parents is that the parents are married and live together and they file a joint return, then as in the case with Richie Rich, we're going to use the joint return of the parents. But if the parents were to file separately, you're going to use the return of the parent who had the higher taxable income. If the parents are married and did not live together and the custodial parent is married filing separate, then you will use the parent that had the greater taxable income. But if the custodial parent is head of household, you will use the income of the parent who had custody for more than half the year. If the parents are divorced and the custodial parent has not remarried, you will use the parent who had custody for more than half the year. If the custodial parent has remarried and the custodial parent and the step parent file a joint return, you are going to use the custodial parent's return. If the custodial parent has remarried and the custodial parent and the step parent live together but file separately, you are going to use the income of the parent or step parent that is higher. And if the custodial parent has remarried and the custodial and step parent do not live together but file separately, you will use the same rules that apply to parents who are married and not living together. If the parents never married but lived together all year, you will use the parent with the greater taxable income. If the parents never married but did not live together all year, you will use the parent with custody for more than half the year. And if you are working with a widowed parent who is remarried, then you go back to the rules for custodial parent who remarried. So that completes the lecture part of today's class. We had a classwork assignment, which is preparation of another amended return. I'm going to go through this assignment real quickly and then pull up the answer key for it. If any of my live students need to rush and leave at this point, I'll give you the final password of the day so that you can do that. And then I'm going to spend a few minutes going on this. I might run a few minutes over, but not much. Password number 3 is LEGO, L-E-G-O, LEGO. All right, so let's take a look at this classwork assignment. It's involving preparation of an amended return for Mary Poppins, and the forms that need to be filled out to prepare this amended return are 1040X, 1040, the Earned Income Credit Schedule, Schedule 8812, and Form 8863. Now, Mary needs to amend her return because she did not claim her younger sister Laura as a dependent on her original return. During the year, Mary provided more than half the support of her sister Laura, who lived with her all year while she was attending college. Laura paid $2,000 for tuition and fees expenses that she incurred while in her third year of full-time studies. Mary's original return also failed to include income from a second job that she worked at for part of the year. This W-2 showed up later after she filed, and she figured she'd better do something with it. And while she was being interviewed to prepare her tax return, it was also discovered that she missed out on claiming her sister as a dependent. So let's take a look at Mary's original return here. You can see on the original return, Mary did claim a dependency exemption for her daughter, and she did file as head of household. So on her amended return, we're going to be adding in her sister as a dependent. And on the original return, there was $36,100 of wage income, but there was that extra W-2 that was left off. We're going to add that in. On the original return, we can see that Mary claimed an education credit. This actually was for herself, and she also claimed a child tax credit. And she had $1,500 of federal withholding. She had an American Opportunity Credit of $160, and ultimately when she filed her return, she had a $679 refund. So let's pull up the amended return and see how things have changed or need to be done. All right, here. So let's look at some key points, and then I'll show you the finished forms. Firstly, increasing Mary's income and adding an additional dependent changes her tax situation significantly. You can kind of predict in your head what's going to happen when at that level of income, she adds another dependent. And at that level of income, she adds a significant education credit. Those are going to wipe out any additional tax she might owe because of that W-2. So she is eligible for the child tax credit. It has essentially eradicated all of her tax for the year, and she's going to get a refundable child tax credit. She's also going to get additional American Opportunity Credit. She's going to get Earned Income Credit. So let's move over to the amended return. And firstly, we need to prepare the 1040. So we're preparing the amended 1040, and on there we add the extra dependent Laura. We increase the amount of income on line 7 for that extra W-2. We go over to page 2. We figure her tax, $2,154, but that's going to be wiped out by the American Opportunity Credit and the child tax credit. So her tax is reduced to 0. And then on the amended return, we're showing additional withholding from that additional W-2. We're also showing the Earned Income Credit, the additional child tax credit, and an increased refundable American Opportunity Credit. So on her amended return, we show a refund of $4,216. On the 1040X, we enter the head of household filing status, and we show the amount of income shown on the original return compared to the amount of income shown on the amended return. The difference is that $3,500 W-2. The standard deduction amount is unchanged, but we do have a change on the exemption deduction. On the original return, there were 2 exemptions totaling $7,900. On the amended return, there are 3 exemptions totaling $11,850. The difference between those is equal to a single exemption deduction. The exemption deduction is more than the W-2, so she actually has a reduction in the overall taxable income. It's down by $450. Next, we show the tax from the tables, and the tax tables show us that her tax has dropped by $67. And then we go in to figure the credits. And of course, the credits are up because of the American Opportunity Credit, but the amount of child tax credit being claimed is dropping. So we have a net reduction in overall tax due to these credits of $981. And then we move on to show the federal withholding, which is up by $600 because of that extra W-2. And then we show earned income credit. On the original return, it was 0. On the amended return, it's $870. And then we also show what is being attached in terms of schedules, and we are attaching Schedule 8812, and we're also attaching a Form 8863. So we go into comparing these differences, and we see that once we have entered the numbers on these lines, that we are due an overpayment or a refund on the amended return of $3537. That the refund on the amended return is $4216, but on the original return she already received $679. And so that $679 comes out of the total refund showing on the 1040. And so the amount showing on the 1040 is not the amount she gets. Instead, we show the difference between the original return and the amended return, and then her amended return gives her a $3,537 refund. The other part to be interested in is this time we do need to complete Part 1 on page 2, because Part 1 is completed when you have a change in the number of exemptions being claimed. On the original return, there was an exemption being claimed for the taxpayer, and that is unchanged. But on the original return, there was only one dependency exemption being claimed, and now we have 2. So we're telling the IRS that there is a change in exemptions of 1, and so the total number of exemptions is up by 1. It's gone from 2 until 3. And the exemption deduction has changed by $3,950. It wants us to list all dependents claimed on the amended return, and in this case there was Jane and Laura. And then in Part 3 we are describing the reasons for the amended return filing. Thank you for participating in today's class on the net investment income tax, other taxes and penalties, and everything else that was in the kitchen sink. And I hope to see you again at one of our classes soon, and bye-bye. We hope you've enjoyed this tax education class. Pacific Northwest Tax School is approved as a CE provider by the IRS and the states of Oregon, New York, and Texas. We have been awarded the Quality Assurance Standard by NASBA and meet the CE requirements for CPAs in most U.S. states and territories. Tax clients demand knowledge and experience. Pacific Northwest Tax School provides the in-depth, practical education needed to improve your understanding of tax law and to meet the demands of the competitive tax preparation industry.